in liabilities. And if you look at corporate bonds that have a maturity of over 10 years, there's something like $3 trillion. So there's a massive imbalance. They can't do that. So what do? Well, they want the credit risk, so they buy short-term corporate debt, and then they use derivatives to get the duration to match what they have to line up with. So I'm going to use the word futures here, but you should understand futures and swaps are both part of this. So think of this as being, I need to have this long-term exposure, and I need some sort of a spread to cover my costs. And so they're in the futures market, and they're on one side of that market. And they create a massive imbalance. Okay, now that market has to clear. So how does it clear? Somebody has to be on the other side. And so hedge funds are willing to do that. So the asset managers, that's what we're going to call the pension funds and life insurance companies and bond funds. The asset managers are long the futures. The hedge funds are short. The hedge funds don't want a naked bet on interest rates, so they staple that together by buying physical treasuries. So now they've cleared the futures market and they don't have an interest rate exposure. And the fact that the asset managers are all leaning to one side of the market means that there's a slight amount of mispricing. So think of 10 or 15 basis points from going short the futures and long the physical. Now that's not enough to get a hedge fund excited, but if you can borrow the money to take this position and let's say lever it 50 to 1, then you can turn the 15 basis points or 10 basis points into money that's worth talking about. And that's what's happening right now in the Treasury market. There's $1 trillion in this trade, okay, $1 trillion. So that means that the 50 to 1 leverage means that the hedge funds themselves have put up very little cash to sustain this position. They've borrowed 49, they put up 1. And that means anything that blows up the $1 that they've got in the trade means that the trade has to unravel, and then somebody has to step in, and when somebody's going to step in, they're probably not going to be levered 49 to 1. So then you're getting a big price discontinuity. And the story of this paper is trying to put that together and then come up with, okay, what would we do if this were to happen? Okay, so, you know, one answer is we just buy everything, okay? And we're going to try to come up with an alternative to just literally buying everything. Okay, so I'm going to give you a series of supporting facts to convince you this story isn't crazy. And then I'm going to close with the policy recommendation. So here's the first part. You can just see that if you look at what the hedge funds are doing, they're borrowing to buy the physical treasuries and they're short the futures. And you can see these mirror image, kind of amazing. The asset managers are on the other side of the futures market. You can see that they're long the futures and the hedge funds are short. And the dealers that are the pass-through vehicles that lend to the asset managers don't have a lot of duration. In the paper, there's a model, and the point of the model is to establish two things, that actually it's the asset managers that actually pin down the demand for the duration in the treasury market. The hedge funds and the dealers are just in this basis trade. So there's this kind of separation where the way you should think about the treasury market right now is the risk tolerance of the asset managers determines how much treasuries, are going to get priced. And if you think about QE, trying to do term premium and all that, that's all about what the asset manager's doing. The basis trade is just this stuff to satisfy what the asset managers need to do to meet their mandates. Another fact I didn't realize until we started this project is the dealers own a lot of treasuries. So notice the scale on this x-axis, or the y-axis here is billions. They have about 150 billion of treasuries. There's a paper that Jonathan wrote that shows here is the exposure of the dealers to a 1 basis point rise in the yield curve across the entire yield curve. Notice this is in millions. There's a factor of 100 here between how much risk the dealers actually have and how much they actually own. So they're flat. They're not in this duration business, and the hedge funds aren't either. And so you've got this situation where this market is working, but it's pretty fragile. And so I make the joke, you can only run this regression if you have tenure. So here's trying to look at what happens when the quantity auctioned of treasuries goes up. And you can see there are these small coefficients that say when there's an auction for treasuries that expands the amount that has to be held, you can see that the hedge funds go out and take the other side of the futures market. The last column there is this clever thing that shows there are certain tenors of treasuries that aren't in this trade. The asset managers don't really want short-term treasuries. That doesn't help them. And you can see when there's more auctions of short-term treasuries, that doesn't trigger a response by the hedge funds. That's what the last column that's insignificant has the different sign. The other 3 columns just show you, depending on which fixed effects you put in there, that when you add the treasury issuance, you get more of this stuff. Here's March of 2020. I think for you, Ben, when you guys did QE3, it was $80 billion a month. That was like an epic event. The Fed, the week of March 25th in 2020, bought $360 billion of treasuries. Okay, that's how this event ended. And you can see that this kind of fits the story we're telling, which is for whatever reason, probably margin calls, the hedge funds decided they had to step out of this trade. Anything that exhausts their capacity means they'll step out. So you can see that they're unwinding their positions. And for a little while, the asset managers are absorbing it. But at some point, they don't have the capacity to do this. So they start turning around. If we had Ken Griffin here, he'd say they start trying to front run us. So you can see that they start going up and going in the same direction. So eventually the asset managers have to absorb this, but they didn't want to. So the Fed is in there buying like crazy to arrest this. And then finally, the graph here is all the related things that the hedge funds are also doing. So my favorite one of these is the GCF tri-repo spread, which I'm guessing nobody in this room has heard of. This compares the rate of return that the dealers get when they borrow from the money market funds to what they charge the hedge funds to lend on the money. Now, the y-axis here is standard deviations. That thing moved by 10 standard deviations. That's what the Fed was arresting, was all this stress. And all 3 of the other trades here are basically versions of stuff where the hedge funds are doing kind of arbitrage-like trades. And the point is, if they get constrained for whatever reason, they're going to step out of everything, and it's going to spread into the financial markets. Okay, so here's the summary. The asset managers are doing this financial engineering to solve this problem that they would love if you could just coerce everybody. Maybe Trump should call a meeting, just say everybody has to issue long-term corporate debt. And if we could get to 30 trillion, this would go away. But we don't have that. So what's going on instead is the hedge funds are assisting them by facilitating the market clearing, but it means that anything that disrupts the hedge fund's ability to stay in the trade will cause chaos. So things you wouldn't think would necessarily be connected, like the hedge funds get margin calls, hedge funds make a naked bet on oil or Ukraine or something like that. They lose money, they have to pull out of the trade. Or their internal risk limits just say there's a lot of volatility, we have to step back. All those things would trigger a potential unwind. Okay, so now the moral hazard police. The Fed could buy, and that would potentially solve this problem. It worked last time, but there's three reasons why we don't really like that. First of all, if you get a free Fed put and you don't pay for it, that seems like not something we want to base the stability of the Treasury market on. Second, when you buy, it looks like QE. Even if you say it's for market functioning, you're buying, you're going to disrupt the term premium, and that means, you know, we have a long discussion about how somehow the financial stability stuff starts in March of 2020, and by September it's now monetary policy, but the amount you're buying doesn't change. So that's there. And then there's this question of, if you do get in for financial stability reasons, you probably want to announce this isn't a permanent thing. It's not monetary policy. I want to get out. When the BOE did the market rescue in October of 2022, there was a lot of discussion about how quickly can we get out. And if you purchase, that's a complicated thing. So what would we do instead? We would like the Fed, they don't have to talk about this now, they just got to have a planning meeting in the background so that when it happens, they're ready to do it, to buy what the hedge funds would really want to do, which is just hand over the hedged position, okay? And we think you could do this through an auction. We even think you could maybe set up a special purpose vehicle so the Fed wouldn't even have to buy, they'd just lend to the SPV that would run an auction. And if the normal basis is 15, or the normal basis spread is 15 basis points, they could even say, we're not going to buy until, they don't have to say it in advance, but they could just let it be known that they're only going to buy at 50 or 60 basis points. So the hedge funds eat a big loss, okay? That's a little moral hazard protection. You don't do anything to term premia, so there's no monetary policy. It's naturally hedged, so you get out, and you don't have to announce when you're going to get out. And you don't have to worry about taking losses on behalf of the taxpayer. So that's our theory of the case, and I look forward to hearing what our discussants say.
All right, our first discussion is Hyun Shin.
Great pleasure to be here, and thanks for the invitation. This is a very interesting paper, and what I'd like to do is put things in some broader perspective so that you can get a sense of why this is coming up right now. When Anil and I were writing about the mortgage market at the start of the GFC, we were showing charts like this, although, you know, just at the first drop. The yellow line is the total assets for the broker-dealer sector in the US. These are all from the flow of funds. And the red is the household sector, blue, the non-financial corporate business. And everything is normalized to 100 at the beginning of 1990. You see that there's this huge run-up in broker-dealer balance sheets. And then when we were writing about the mortgage market, we were just seeing that very sharp drop. Now, things have recovered a bit. But if you look at the leverage of the broker-dealer sector, it's way down. So when we were showing these charts, you know, we were sort of, you know, kicking ourselves. How could we have missed this in a run-up to the GFC? But if we were just looking at the, and I guess the lesson learned was if you track balance sheets and leverage, then that's a good way to identify risks building up. But as Anil was showing, there's a lot of intermediation going on elsewhere. So where has it gone? So if we sort of summarize before and after the GFC, so here are, I think, sort of what we you know, could characterize as being the main features. So before the GFC, the focus was on private sector liabilities, mortgages, corporate bonds. And the broker-dealer sector, they warehouse the claims either on balance sheet or through the various special purpose vehicles, you know, the conduits, et cetera. And so the lesson that we took away from that was, well, let's make sure that we measure these things. And if there's something that's growing very fast, let's you know, look at that with some skepticism. I think what Anil has shown us is that after the GFC, the focus has shifted now. It's shifted to the sovereign bond market from the private sector liabilities. And if we were just tracking the broker-dealer sector, you know, we would have missed what happened in March 2020. So maybe it's time to unlearn, you know, unlearn this lesson that we had learned at the time. But instead, I think there's been a structural shift in the financial system where short-term funding markets, repos, and I'll show you later, FX swaps are playing a much more important role. Now, if you recall just at the height of the GFC, do you remember these New York Fed wall charts? We had investors on the right-hand side. They lend on, and there's a bunch of SPVs in the middle, and then there are the ultimate borrowers on the left. If we look at it now, it's actually all those middle boxes have disappeared, and instead what we have are clear, various market infrastructures that are now relying on clearing. So there are central counterparties, there are tri-party repos, and the repo market has become very, very important, with the Treasury market as being the base for this. I think it's worth thinking about why this has happened. Why has there been this shift from the mortgage market to this kind of infrastructure? And I'll perhaps offer some hypotheses later. But one thing that we do see is that the repo market is taking a very, very important role. So this is one slice of this. This is the money market funds in the US with Treasury and the agency collateral. It's the repo with these, with this collateral. The black line is the Fed's overnight reverse repo program. That's come right down. We still have a lot of repos that are being financed. Now, Anil didn't show this particular chart, but I think this is the key chart in the paper. He showed us the other futures chart, but this is the key chart, which is what this has done is to enable this relative value trade where you're financing the long Treasury position with repos, and that's the dotted line. And you're hedging by having the short futures position, which is the blue line. And of course, the lower the margin on the repo, the higher the leverage. Actually, you need both the futures and the repo to make that happen. But let me get back to that later. So, assessing this policy, well, clearly this is going to work. So, what Anil and co-authors are suggesting is, there should be, when the relative value trade is unwinding, the Fed should come in and basically take on exactly the positions that are being unwound. So buy the treasuries and also buy the short the futures. So clearly ex post. So once you're in that situation, this will mitigate risk. So as a palliative, this is going to be a very, very effective policy. But I think ex ante, we have to question, what kind of positions will be built up if the hedge funds know that this is, in the background. Another way of saying that is the position size is going to be endogenous, and what could be the economic impact? Well, I think what March 2020 showed us is that a financial stress event can also happen in a market for safe securities. So that there's no default risk, but the stress propagation is coming from the market prices. So think of it like this: if a sell-off in the Treasury market causes a spike in mortgage rates by a couple of 100 basis points, that's going to have a very big economic impact. And I think the other issues have to do with what are the long-term consequences in terms of the bank business models and also the monetary policy implications of this. So I think one thing we should bear in mind is that central bank balance sheets are still very large, and these are the liability side. I think this is, perhaps the more important element when we look at this. The red part is the reserves held by the banks, and because these reflect the sales of the securities, there's going to be something else on the bank's liability side, which tracks the the payment to the holders of the security who had actually surrendered that, and that's going to have an impact at the margin on the availability of short-term funding, and one could argue that this is why the repo market has become such an important market in recent years. There are issues to do with the monetary policy impact. And I think Neil mentioned that it's going to be indistinguishable, at least in action, whether it's the intervention is for financial stability purposes or monetary policy purposes. We can sort of calculate various measures of the shadow rate, but this is just one example from something that we've done, where the blue line is some kind of monetary conditions index. If we take account of the standard trade-offs between the balance sheet size and the policy rate. But I think the other aspect, so this is not in the paper, but I think one thing worth thinking about is what are the international implications of this as well. And the FX swap market, I think, is probably understudied, but it's probably worth greater attention, because the other way that short-term funding works is to actually use the short-term, the ability to provide short-term funding to go international. If you look at our latest data on the FX swaps, it went from around 21 trillion just after the GFC, and it's now 60 trillion. It's basically tripled in the last, since the GFC. And this stuff is not on the balance sheet. Remember, it's off balance sheet. It's dollar funding, but it's off balance sheet because it's a derivatives contract, but it's nevertheless funding in dollars. And 90% of this is in US dollars. The other currencies pretty much track what we would expect. It's the other international currencies, the euro, the yen, sterling, and Swiss franc. Those are basically the other counterparties here. And this is why whenever something happens in the treasury market and there's some stress in the funding market, we see the impact going well beyond the US market. So just to sum up, I think this is a very innovative and very cogent proposal as a stress mitigation tool. But we have to question what the long-term implications of this would be. The position size is going to be endogenous, because if you basically cut off the left tail of the outcome distribution, this is going to enable larger positions. And even though these are safe assets, there will be very large economic implications, through the yield curve. And when we look at the evolution of bank business models, it's been very, very difficult to shrink the balance sheet because business models have adapted. And we see it in the repo market and in the FX swap market. I think the monetary policy implications will still need to work. I think one thing that they do talk about in the paper, but I think it's probably a better way, would be to bring this idea of congruent regulation. It was presented at this meeting a few years ago by Andrew Metrick and Dan Tarullo, which is the idea that when we think about the leverage that's obtainable through these clearing infrastructures, we can think about the relevant leverage ratio there as compared to the bank balance sheet. And they're arguing that we have to have something which is congruent. And of course, lastly, the big elephant in the room is sustainable fiscal trajectories. But this is not the time to open that discussion. So let me finish there.
Our second discussant is Annette Wissing-Jorgensen.
Thank you for the opportunity to discuss I work for the Fed now, so the usual disclaimer applies. In the background of this paper is the dysfunction in the Treasury market in March 2020, as illustrated here by the blue line. From March 9 to 18, the 10-year Treasury yield went up by 64 basis points, despite the fact that economic news was coming in worse and worse, as illustrated by the red line here, which is the S&P, which kept falling during that same time. So the Treasury yield spike was not due to, for example, high expected inflation or credit risk for the government. In fact, if you look at the real CDS-adjusted yields for the government bonds, they went up even more. So instead what happened was that there was a combination of two things. There was a negative demand shock for treasuries, and then there was insufficient intermediation capacity, leading those leading that selling to have higher than expected price effect. So there was 3 groups selling. The first one was bond funds. They had outflows, and they disproportionately met them by selling treasuries, because those were the most liquid ones that they had. Foreigners, a mix of official and private, but mostly official, with central banks selling for FX intervention. And then finally, there's what's the focus of this paper, which is the hedge funds selling treasuries as part of an unwind of the basis trade. Each of these 3 categories led to between 200 and 300 billion of selling in the first quarter of 2020. The other element is this intermediation capacity issue, and you can sort of see this from how the Fed's market functioning purchases worked. These were, I think everyone will all agree, were very effective. But what's interesting is that the yields on both Treasury and MBS fell with what the Fed did, not with what the Fed said. So the Fed made an announcement about purchases on March 15 and 23, but yields fell not on those days, but on the days where the Fed really ramped up its purchases, as illustrated in the left chart for the Treasury market, where the blue line again is the yield, and the red is the Fed's daily purchases that ramp up on the 19th. The right chart is the MBS market, and just for the sake of great identification, the Fed delayed its interventions ramp up there by a day, leading to great identification. You can see there the purchases go up 1 day later and the yields go down 1 day later. So that suggests that there was, because of this, it was about what the Fed did, not what the Fed said. There was something about the plumbing that wasn't working right. Fine. So the potential problem is that the Fed, kept buying for a long time. So the left chart here is for the Fed's quarterly purchases. You had in Q1 and Q2 of 2020, about $1 trillion bought, but then the Fed kept buying over 200 billion for another 6 quarters. And I think this is sort of where the authors are feeling a little uncomfortable with that. You can see in the right chart that this led the Fed's COVID interventions in the Treasury market to be as large as the combined effect of QE1, 2, and 3. So that's a big thing. So it contributed potentially to what happened in the economy, both in terms of inflation, maybe the housing market. But what's more the focus of the paper actually is that it contributed, of course, to large Fed losses, because the Fed hung on to these bonds and then rates went up and the Fed had losses from these purchases and the earlier ones of about 1 trillion unrealized losses by the end of 2022. Now, of course, the Fed is not here to make money, but nonetheless, that is a lot of money. So something that a key argument in the paper is that there was this morphing where the Fed initially bought for market functioning, and then they were kind of unclear about why exactly they were buying, and then they just kept buying, and then they had a lot of losses. The proposal then is that if the Fed were to hedge, that would have a series of benefits. Where the first one would be that there would be a clear distinction between market functioning and QE, which would, both for the Fed itself, avoid confusion about how much exactly we're supposed to be buying, but also for the public, there would be a clear separation, as in the Bank of England case. The second benefit would be that the Fed has less profit risk, both from the purchases themselves, these 200 billion of counting the basis trade. That's probably less of a big deal, given that that was not the majority of the Fed's purchases, but nonetheless. And then also from potentially, if the Fed was not confused and didn't buy too much in QE, then of course that could potentially lead to much lower losses. I'm not going to get into the moral hazard issues here and cover that. This is not all just history. The basis trade, as Neil said, is now something like $1 trillion. It's a big deal. Fine. I'm going to have 3 comments. The first one is that the main point of the paper is not quite what the authors say. So if you read, here's a quote from the paper. It says, to relieve the stress on dealers from absorbing the basis trade when it unwinds, it would be sufficient for the Fed to take the other side of the unwind, buying treasuries and fully hedging. This is a more surgical approach to bond buying. So I must admit, the first 2 times I read the paper, I thought that this meant that they're saying that the Fed treasury purchases are equally effective for market functioning, whether you hedge them or not. But that's actually not what the model and the framework is saying. What the framework implies is that entering the futures market helps. It has a powerful effect on market functioning. And therefore, dollar for dollar, actually, Fed treasury purchases are actually more effective if you hedge them rather than if you don't hedge them. I'll show you this in detail in a second. So I think actually, rather than potentially preventing losses, which I'm going to argue is not something I think would have had a big effect, one benefit of this is it might be able to allow for actually smaller interventions because they're just more effective. So for those of you in labor, here's your slide. So this may all sound very technical, but it's really not. So if you think about treasury futures, this is just buy now, pay later for treasuries. So an asset manager that that takes on a long future position effectively buys a treasury now but pays an agreed upon price later. Now, of course, the asset manager could borrow through repo, but asset managers don't like that as much because the logistics are more complicated, and also the funds would have to disclose interest paid as fees, which may be bad for them. Okay, so there's some no arbitrage that doesn't hold, which just says that agreed upon price later, the futures price, is not just the future value of what you could have bought the thing for today. And that's that inequality I put. And that when people talk about the treasury basis, they're just talking about how big is this deviation in percent. Okay, so why do asset managers use leverage? Well, in the paper's model, it just goes into the riskless rate. But as Anil said, in practice, it's to basically get some credit exposure, to try to get some alpha while hitting your duration target. Fine. So in the model, simplifying the whole thing sort of down to one page, there's three players. There's asset managers that want a bunch of duration exposure that they get in fixed proportions from futures and treasuries, where theta is the part they get from futures. Their total demand for treasury exposure depends on the term premium. And the futures demand is just some constant times the total. Okay. Then the dealers, they supply futures and do bond intermediation. And a key insight that didn't come across as much in Anil's remarks is that the dealers are going to equalize the marginal return from doing one thing and the other. So if the basis is very attractive, they're going to want to go into the basis and do no intermediation. And so that causes all these plumbing problems, that if the basis gets screwed up, then the impact of people selling is going to be really bad because there's plumbing problems. Similarly, the hedge funds, they also supply futures, partly with repo, but important, they also have other things that they can do that has alpha, and they equalize these marginal returns. All right, so to affect market functioning, what the Fed needs to do is to affect the treasury basis, which is determined in the futures market. And the key insight is that they need to do this so that the dealers don't stop doing as much intermediation, because that messes the whole thing up. Okay, so the whole paper in one equation here. Let me see how well I'm doing. The futures market has three moving parts. On the left-hand side is the supply from the dealers and the hedge funds. Each of those depend on the basis. On the right-hand side, there's the demand from the asset managers, which depends on the term premium, because that determines how much duration they want, and the theta, which is how much that they're going to get from the futures market. So when the hedge funds exit, the Fed has two levers. It can enter the futures market to replace the hedge fund supply that walked out on the left-hand side, or it can try to lower the term premium in order to lower the asset manager's demand for duration, and thus futures on the right-hand side. So basically, the Fed can solve the problem, the market functioning problem, either by taking a hedge long position, literally just stepping instead of the hedge funds. That's going to one-for-one affect the futures supply. It's not going to do anything to the demand, because since the Fed doesn't take any duration risk, the term premium doesn't move, so the asset manager's demand is not moving. Or the Fed could take an unhedged long treasury position, as it did. That is going to take some duration risk out of the system. It's going to lower the term premium. It's just going to affect the right-hand side, but there's that theta. So because the hedge funds have left on the left-hand side, kind of dollar for dollar, but the Fed only changes demand theta per dollar that it buys, then this is just not going to be as effective. And therefore, and that's my key point here, the unhedged position will have to be larger by a factor of 1 over theta intuitively, because the unhedged position doesn't get as directly to the problem, which is that in the futures market that the basis is blowing up. Just for the sake of the argument, you could actually get there also by just taking a position in the futures market. That's not attractive because it increases the term premium, but just so you can see how this works. Thank you. My second comment is that I'm skeptical that this would help with Fed losses. So specifically, did the Fed buy more than it would have for QE purposes alone due to an excessive and entangled function of market functioning? And I think no, because I think the amounts that the Fed bought from Q3 2020 onwards were bigger for QE purposes than for what they were buying for market functioning purposes, meaning that the actual amount was driven by the QE. So a couple of arguments. So market functioning improved quickly, and I think the Fed agreed and acted on that. So Anil said in his Jackson Hole intervention last year that any sort of market functioning motivation should have been gone by the summer, and I think it mostly was. For example, the cheapest to deliver treasuries, which are the ones involved in the basis trade, were explicitly excluded from Fed purchases from April 20th. The daily purchases, as you saw in one of my first charts, were adjusted down pretty quickly as things got better, and were similar to peak QE purchases from the third quarter. If you read the 2020 July minutes, Lori Logan said, market functioning is returned, many indicators are back to normal. As a result, we bought the minimum possible. And staff gave presentations about QE in the standard sense from June 2020, again, according to the minutes. Furthermore, as has been stated in this forum, the Fed went all out on both on both asset purchases and forward guidance, suggesting that they were not just buying because they thought there were still market functioning issues, but that they thought there was a big need for stimulus. This is the, by now, perhaps somewhat dreaded and forward guidance that people have spoken about. Finally, by December 2020, the Fed was clearly focused on QE. They gave outcome-based forward guidance for QE. And the amount purchased didn't change. I put a vertical line. There's no change. Suggesting that it's not like sort of focusing intently on monetary policy led them to a different number than the one they were buying before, suggesting that QE was the dominant amount setter even before. So why did the Fed come up with so large QE4 numbers? Presumably because the lessons from the GFC was you needed a lot of demand stimulus. I think we all, as a profession, has to take some blame for maybe misdiagnosing the COVID problem as something one could solve with a big boost to demand, as opposed to recognizing that it was, to a large extent, a supply problem. And also one should recognize that any reasonable staffer at the Fed who were calibrating QE would see very large treasury issuance and presumably would say we need to counter some of this to get to the same net effect on the economy. The blue here is the quarterly issuance, which you can see from Q3 onwards are much bigger than the Fed purchases. So even with large Fed purchases, there was still a lot of net issuance. Finally, if I have a second, so the conclusion from the second comment is I don't think that hedging would have somehow clarified the Fed's thinking and led to lower QE and lower losses. My third comment is it possible that hedging could actually help the credit market? So as Anil described, the asset managers demand futures to add credit. Here's a slide from the TBAC, where the idea is you're a manager, you're trying to beat the Bloomberg index that has a lot of weight in treasuries. The way to do that is to lower your treasury positions, add duration through futures, that's a green bar to the right, and then buy a whole bunch of stuff in orange, that's a whole bunch of credit that you think has positive alpha. If you do this carefully, I'll put an example in the appendix of the write-up, you can get to the same duration while having a higher expected return. All right, so what's interesting here is that the asset manager's preference for doing this is cyclical. So from the TBAC guys, they say the economy is healthy, bond managers prefer credit relative to treasuries. And this cyclical preference for credit is driving their futures demand. Now, if you think about that, that means that in terms of what's really the underlying driver of all of this is the asset manager behavior, which is going to be driven not only by debt supply, which is heavily emphasized in the paper, but also how attractive is this whole credit trade, which is going to be cyclical. So to the right, you can see the asset manager position, long futures positions, along with the Fed funds rate as a proxy for the state of the economy. You see they're actually much more tightly linked than in the left picture. So there's actually two, not one driver. So then just to conclude, if you think about this from the asset manager's side, they're going to unwind this either because the economy takes a turn for the worse, so having a leveraged credit position is not great, or because the funding cost of effectively funding those credit purchases through futures is expensive, and that's measured by the basis. So is it possible then that the Fed entering the futures market could indirectly help stabilize the credit market by reducing the basis or the expected basis, and could that help reduce the Fed's need to support the credit market, which I think is still at this point somewhat controversial. So overall, it's a great paper. The main policy suggestion is interesting and maybe useful. I'm skeptical that it's useful for reducing losses, but it may allow for smaller interventions, and it might also help the credit market. Thank you.
All right, let's open it up for questions. I'll start with one myself and then hand it over to other people. So I found the specific suggestion about this market, which is a very large market, convincing. But both of the discussants mentioned other things that were, big trades that were going on at the same time, for example, in the FX market. So I was wondering because this was very specific to this one market, are there similar things that one could set up similar type of hedged things in other markets, like, for example, the FX market? And would that make the same amount of sense, or is it somehow very specific to this example, the proposal that you're making? Mike Kiley.
How does the technology work? Okay. Thanks. Really nice paper. I had one observation and two questions for the authors. So the observation is it's restating something Annette said, but in simpler words. I do wonder, there was a paper, I believe, in the fall, I wasn't here, that also emphasized it's valuable, clear communication to separate market functioning purchases and stimulus purposes. I would make the observation that while that's really important from a communication standpoint, it was clear we needed a lot of stimulus during all the times when there have been QE. So it's sort of like a problem that in practice is a little different than I think is characterized in some of the literature. My two questions, one is probably a little bit naive, and then the other is to ask the authors their thoughts on something they say they're not going to talk about in the paper too much, but mention. In their discussion and in others, there's an emphasis on this insatiable demand for duration, and achieving that through futures. I just wonder why, and there was the same question in the LDI episode in UK, there's just this insatiable demand for duration. Why are prices in these markets not adjusting, and corporations and others just taking advantage of this incredible appetite for duration, in their funding, and what are we missing there that there's this huge appetite, but the market doesn't seem to be, what are the imperfections there that are driving that? And then I think my other question is on congruent regulation. I think it's really important. A lot of the discussions of congruent regulation seem to be that we should be weakening, or reducing regulations related to banks. I think the metric in Tarullo was to move in the opposite direction. And I wonder what mix the authors think might be helpful, because I think those sort of ex-ante measures are important, when you might be putting in place these sort of ex-post measures as part of the efforts to mitigate moral hazard.
Mark?
All the presentations were very good, but I missed some important details about the plumbing that I'm wondering if the panelists could clarify. In particular, I was taught that QE works when the government or when the Fed can do something that the private sector can't do, because the private sector can go short and buy assets just as the Fed does. An advantage the Fed has is it's better able to, or we think it has, is it's better able to handle duration risk, and that allows it to affect term premium with asset purchase. So at the first blush, it would seem like these positions are hedged. You weaken some of the Fed's advantage in manipulating term premia. And so I'm wondering just what am I missing? Or what did I miss?
Why don't we go back to the authors for a little bit, and then we'll take a few more questions.
I can take a few. So first, thanks very much both to you and Annette. These were terrific, not only for terrific discussions, but for really helpful input on the last draft of the paper. Let's see, I'll just take a few. First, Annette, you made, I think, a beautiful and pretty subtle argument. I'm not sure everybody caught it, that doing it hedged is actually more powerful kind of unit for unit than doing it unhedged. That's great. I don't think we'd really thought about that, but I don't want people to lose sort of the big picture, which is, why did we do the purchases in 2020? We think the dealers have been overwhelmed by Treasury selling. And it's true that they're holding a lot of Treasuries, but they're not overwhelmed by duration, right? They're completely hedged in March of 2020. So if the goal is to relieve stress on the dealers, you can do that at least as well. You're, I think, even strengthening the argument by saying you can maybe do it more effectively by taking the hedged position off them, and thereby, saving the Fed from having to do anything that looks like monetary policy. So, Mark, to your point, yeah, you are taking away this tool, but that's the monetary policy tool. And as a result, you're doing, in some sense, a smaller and more modest intervention. You know, Hyun, you raised sort of a couple things about a large central bank balance sheet. It's true. I guess this is a somewhat separate point. You know, doing this will make the hedge funds more aggressive. That's a variant on a moral hazard argument. I think we would concede that to some extent, but the benchmark is not zero moral hazard. I don't think anybody wants to be in that state of the world where the Fed is forced to buy bonds. That's a bad state of the world, and there's going to be some moral hazard. I think we're just saying relative to the outright bond buying, you can do somewhat better on the moral hazard score if you're hedging, because at least now you're not providing an outright Fed put on the term premium. So there's still a problem, no doubt. And you know, people asked about a bunch of other policy tools. I think we're basically favorable towards many of them. Some degree of margin requirements, potentially a loosening of the supplementary leverage ratio, and all of those are helpful. I think we would favor even more aggressive standing repo facility than the Fed has, one with broader access. All of those are helpful, and all of those might be kind of your first line of response. But as we saw, when things get really bad, at least in the event, the Fed finds itself in the position of buying, and so we just want to have a tool that does that better. It's not to say that we prefer this to the other things. You can think of there being like a hierarchy of, you know, from small to big interventions. It's just before you get to the biggest one, we want to propose something that we think has a somewhat smaller footprint. Related footprint, you talked about sort of the problem with a large central bank balance sheet, maybe too many reserves in the system. Again, that'll be true whether you do this hedged or unhedged. And I think there's a somewhat separable question. As you expand the balance sheet, if you're uncomfortable with the amount of reserves that creates, the Fed is always free to tighten up the spread between reserves and RRP and have more of its financing basically come from RRP. And as a result, if you're concerned about glutting the banking sector with reserves, that can be managed. John, you asked about similar things in other markets. I mean, maybe this is not, you know, think about the CIP basis and the Fed swap lines. You can think that one of the things that the Fed swap lines are doing is, in effect, helping to close the arbitrage spread when covered interest parity violations get large. So I think, you know, it's part of, at some deeper level, I think this is all kind of Friedman rule-esque, that, you know, the Fed can provide at very low cost balance sheet when the rest of the financial, and you know, is not taking any economic risk by doing so. So, you know, think about what you know, in the Milton Friedman concept, what does the Fed do? It provides money by holding short-term T-bills, not really taking any duration risk. These things are very similar in character. And I should say, Neil didn't explicitly say this. Yeah, what this transaction is, you know, the Fed doing repo is like the most standard kind of thing. This is essentially almost like repo, right? Because what are you doing? You're buying with a forward, an agreement to sell forward. The only difference with repo is you have two different counterparties. Right? Normally it's the same thing. Here you're buying from one and you're doing the futures contract with somebody else. But in terms of the Fed's economics, it's the same, it's basically the same as repo. So it's a quite, I think, relative to QE, which again, it's more powerful because it's doing a sort of a more aggressive thing. This is much closer to repo than it is to outright bond buying. So again, in terms of the hierarchy of aggressive intervention, I think it ranks lower. Finally, just on Mike Kiley's point about how important is it to separate? Well, you're right that March 2020 was a time when you had both a market function problem and a desire to ease policy. There are going to be times potentially when we have a market function problem and there's some inflation, and then getting the signals straight will be maybe even more important. Let me stop there and see if anybody else wants.
We can take more questions and then come back to you guys. Michael.
I was wondering if you could, I think Annette talked a little about the asset managers and kind of their objective function, but I was wondering if you guys could talk a little bit more about, you know, what drives, it was sort of posited that they like corporate bonds, but what sort of ultimately behind that? Do they just believe that the spread on corporate bonds is, that the spread on corporate bonds is really rich now, or is it, there's some kind of market dysfunction there that creates alpha, as it were? I guess the other question I have is whether treasuries look like not quite so risk-free as they used to, and is that a motivation for thinking that, you know, they're better off in corporate bonds than in treasuries? I can't help but notice that even if the credit default swap on U.S. treasuries did not go up in 2020, it has kind of widened since then, more or less at the same time that the swap went negative. And I was wondering if, I've always wondered about whether that's just something like cryptocurrency that people speculate on that has nothing to do with any of these fundamental sort of drivers of interest rates, or whether that's linked to any of this. So I was hoping you could think about that.
Charlie?
Thanks. Really nice paper. I wish I understood it better, or understood it. I'm going to be reading it very carefully later. To the extent that a motivation for the paper is Fed losses and how to avoid that, I just want to make a couple of comments, ask a question. I mean, you know, the Friedman rule approach is very attractive to me, economists. To the public, I don't know. I mean, and what is it that the public understands? And so the public's understandings of the Fed's balance sheet and losses, I think, is very troubling. Ben Bernanke's here. You know, first he spent a lot of time talking to people about how, well, if we did take a loss, you know, over 25 years, we're going to get back even more. You know, to the public, so you really shouldn't be worried if we, you know, have something bad happen. During that time period, it didn't, but then, you know, their remittances deferred asset from the Fed this time. So in 2023, the Fed had a deferred asset of 116 billion. They paid interest on reserves expenses of 176 billion, and the Fed didn't pay IOR, you know, before 2009. And that's a Friedman kind of thing. You know, so it's better to compensate banks for that, but is it really? What if we did less? What if we only paid 50% reserves at the IOR? Having the IOR is useful as an administered rate. This is all about how you get the Fed funds rate determined for a policy rate, and that was the selling point for the legislation to do this, and you could do it with an administered rate. You could probably do it with compensating less than full reserves or something, if this was important. But again, I mean, the comment that over a long period of time you're going to do better should be compelling for the public, but it isn't. And so, you know, you have to devise these policy tools with that in mind. And I'm just going to guess that policymakers at the moment probably think that the standing repo facility is their next best possible goal here, and getting rid of stigma there would be really useful. But it's a great paper. Thanks.
Ben? It's always on.
Always on. There was commentary at the time that Dodd-Frank was part of the problem with the capital increases in capital and reduced capacity, et cetera. And I'm just wondering if there was anything in Dodd-Frank that made this problem more likely or worse.
Jonathan?
Yeah, I mean, so one of the things is, I mean, a little bit of follow on to that, right? I mean, we did constrain broker-dealer balance sheets in Dodd-Frank to some extent. And Jeremy, you just rattled off a number of, you know, potential other policy changes that could address some of the risks in this market. But one of the things that is sort of appealing about this solution, and I was curious if this was actually one of the reasons you arrived at it, it actually maintains a lot of liquidity in this market, right? Because there's actually some risk if you dry up this market, you're going to fail to have that hedge fund liquidity in the treasury markets in general. And I was curious how much of the benefit of this policy idea that was.
Okay, let's go back to the authors.
I'll just say something quick on regulation. I think, you know, I think it's a pretty commonly held view that the decline in sort of the size of the dealers relative to the Treasury market has something to do with regulation. My guess is that the risk-insensitive leverage ratio plays some role there, possibly Volcker as well. I think, again, we would certainly think that if, you know, maybe I'll just speak for myself, if you could, in some sense, dial back the leverage ratio while making a compensating adjustment to risk-based capital so that the overall capital in the system didn't decline. I think that's an important caveat. But with that caveat, I think dialing back the leverage ratio would probably be helpful in this regard, would probably move some capacity back to the dealers. Having said that, as to whether that helps sort of 20% or 60% with this problem, not sure. I mean, I think what's happening in the event, the dealers are getting this huge trade dumped on them. I don't think it's only, they're going to have their own risk limits and things like that. So I don't think it's only the regulatory stuff, although I'm pretty confident that there's some there. I just want to speak to the Fed losses issue. The way I think about it, it's not sort of the ex post realization was the ex post realization, but ex ante, there's a lot of talk about the Fed's footprint and how big should the Fed's footprint be. I think it's sort of wrong to think of it just in terms of the raw dollar size of the balance sheet. It's sort of, to some extent, when the Fed does QE, and of course there's a reason to do it, but it is also stepping on the Treasury's debt maturity choice, right? Because it's changing the consolidated debt maturity. And I think that's all else equal, sort of expanding the footprint, economically, politically speaking. So I feel like the less you can do of that, that's a virtue in and of itself. Aside from sort of the morphing points, it's just having a more modest. And so again, when you need to do QE, that's a necessary cost you have to bear. When you're doing market function, our argument would be you don't need to do that kind of duration expansion, which again I think steps on the role of the Treasury in setting aggregate debt maturity. Yeah.
If I could add something, I think conceptually here, when we've moved from a lot of dealer intermediation, like pre-GFC, to a lot of intermediation done by hedge funds and other asset managers, a challenge there is when you think of these large dealer banks, they have deep pools of liquidity, and they also intermediate all markets. So if there's stress in one market, they can reallocate capital internally. Now, when we've seen disintermediation, as Hyun's shown as well, where the balance sheet of the dealers and its leverage is sort of flat or shrinking relative to the size of these asset markets, and more of this intermediation is leaving towards hedge funds, these hedge funds are specialized and much more levered, and that makes them more fragile. So in a sense, our policy recommendation is, well, the dealers previously could do this, now they can't. And Matt Levine put it really nicely where he said, maybe we should think of the Fed as sort of synthetic lender of last resort. It's no longer helpful to just have like a very narrow sense as to how to intervene because perfect substitutes, which we as economists think should be perfect substitutes, aren't behaving like that in financial markets.
All right, let's thank the panelists. So we'll break and come back at 10:20.
Third, fourth.
recovering from COVID, and Jim Stock will be presenting.
We're doing a demonstration project this year where we're actually
Okay, let's get started again. So the second paper of the morning is recovering from COVID, and Jim Stock will be presenting.
Okay, thanks so much. So this is a nice opportunity. Remember 5 years ago? It's an opportunity for a nice little walk down memory lane. We're going to look at the COVID episode from a big picture business cycle perspective. I want to remind you of four things that are particularly different about the COVID business cycle, and one that you might or might not be aware of. A couple of them. First, it was really deep. It was really short. Second, there was this big sectoral shift. You know, we all went home. We didn't go to restaurants. That actually persisted for a while. We bought recreational equipment that you could use outside and at home, that sort of thing. Another one is that we had exceptionally aggressive fiscal policy. We just had a conversation in the previous paper about aggressive monetary policy, but the fiscal policy was really aggressive too. This is a plot. I want to spend just a second explaining this picture because you'll see a few of them. All right, so the blue line, everything starts from a NBER business cycle peak. So that's February of 2020 for the COVID episode. And the dark blue line is the COVID data. The other lines are other expansions over the last 6 decades. And so this like really stands out. This is really different. And everything scaled to 1 at the beginning of at the peak. So there's the CARES Act, which happened right away. That happened, it was signed on March 27th of 2020, so, you know, a couple of weeks. And that was the first round of stimulus checks. There's a second round of, and other things too, Paycheck Protection Program, PUA. The second peak there is the January 21, the second Trump stimulus or transfer payments, Consolidated Appropriations Act, and then there's the third one, which is the $1,600 checks that went out with the American Rescue Plan, so that's the Biden stimulus. So there's these 3 really big stimuluses that are really big in any historical context, order of magnitude. Oh, the blue part, okay, so all of these charts are going to have a little bit of this blue shading, and the blue shading is the pre-vaccine period. You remember the first person got vaccinated in the middle of December. It was this nurse, I can't remember, that was on TV. But, you know, we sort of, by the time we could get the vaccine and finally got it, it was kind of, you know, the February, March, April timeframe. So sort of ramps in. And it kind of coincides with the American Rescue Plan hitting the pavement. Okay. So another thing, exceptionally fast recovery. I'm going to come back to this slide at the end. This is a picture of the log unemployment rate. This is stimulated by some cool papers by Bob Hall and Mariana Kudliak. And they point out this regularity that in the previous expansions, the unemployment rate declined by about 0.1 basis point per year. It's just this empirical regularity that just always seems to be true, except not in COVID. So it was an order of magnitude faster decline of the unemployment rate in COVID. And actually, this is important, it occurred in 2 spurts, the initial spurt, and then a second spurt that was after people more or less vaccinated, after the American Rescue Plan, Recovery Plan, Rescue Plan was passed, and that's a second really steep decline in the unemployment rate before it plateaued at more or less full employment. Final thing, and this is the one you might not know, is that this is the first recession first business cycle, I should say, in 6 decades for which we actually re-achieved the trend from the previous business cycle. So these straight lines are peak-to-peak linear regressions for the log of GDP, and you can see we never re-achieve that peak. So you think about that as maybe some base drift or unit root behavior or maybe slowdown of growth, except not in COVID. So that's actually pretty interesting from a business cycle dynamics perspective. That's the first time in 6 decades, probably longer. Okay, so what summary? This time different? Yes, this time was different. Is there a simple quantitative model that captures these? And yeah, we're going to propose that. Our macro dynamics back to normal. So part of our model is it sort of had this thing happen and then it comes off. A statistical model seems to have just come off, seem to be back to more normal, and we'll document that in a bunch of different ways, mainly in the paper. Then I'm going to talk a little bit about the underlying economics of what happened and whether there's any broader lessons, especially policy lessons. And I should stress that especially the broader lessons, I'm really interested in hearing what this group has to say. We'll have some minor opinions, but I think that's a big discussion that we should have. As I was just saying to John Haltwanger, I think we would all prefer never to have to think about COVID again, but I think there are a few things that we will highlight that is worth understanding a little bit better. Okay, so we use a dynamic factor model. This has been around for quite a while. It's a really very efficient way to describe co-movements of macro data. I'm going to distinguish between the old pre-COVID dynamic factor model and what the heck happened during COVID. So the pre-COVID dynamic factor model says that you've got some latent factors, not very many of them, like we use 3 latent factors F. Those latent factors F are related to some shocks, factor shocks. We might think of those factor shocks as being shocks to aggregate demand, monetary policy shocks, uncertainty shocks, the usual flavor of shocks that have been studied, studied a lot. And that allows you to do a decomposition, impulse response functions from those shocks to the macro fluctuations, and then there's some other stuff that each of the series. So we use 128 Ys, 77 used for estimation. So we have 128 Ys. We explain them by 3 Fs. The first question is, does this explain the COVID episode? And the answer is not even remotely close, not a prayer. So what do? You could throw up your hands and you could say the world is different, but then maybe the world comes back together again. Everything is. That's not what we do. We like to have we sort of think the world doesn't change. Monetary policy still takes a while to have an effect, et cetera. But one thing that really is different is that those shocks that we had, the normal shocks, just don't explain the COVID episode. So we're going to add in some COVID shocks. We're going to add in a COVID factor, which appears on, March 12th, 2020. And then at some point, and that's an empirical question, when does it disappear? That COVID factor can affect the actual conventional shocks. So it can affect aggregate demand. It can affect fiscal policy. There's also a potential feedback from the F shocks to the actual COVID factor. So if you think about it, that's actually summarizing what's going on in this big epidemiological economic or EPIEC literature that says, okay, if you're looking around and you see that the death rate is going up, you say, oh my gosh, that's not great, and you're maybe going to cut back your cut back on economic behavior. So it's that feedback channel from I get some money, it's stimulus, for example. I go out to a restaurant, I catch COVID, I go to the hospital, I die. Mark says, oh gosh, look at that, my co-authors are dying, maybe I should do some self-protective activity, okay? But that takes a while. That takes a while between when I go out to the restaurant, get my COVID check, to the fact that Mark notices, and that means that I get a little bit of a lag exclusion restriction. So I'm going to use that lag exclusion restriction to identify the COVID shock. If I can identify the COVID shock, I can identify the space spanned by the other shocks. I'm not going to delve into whether it's monetary policy or fiscal policy, but I'll point some fingers at fiscal policy. Okay. Here's the COVID shock. There's a whole bunch of fit stuff in the paper. Not going to do that for interest of time. Here's the COVID shock. And so you can see the COVID shock. The COVID shock is in black, and COVID deaths are in red. And you can see that the COVID shock spikes in April. That's when we see the spike of March and then April of the COVID deaths. The first wave subsides with all of the NPIs and the lockdowns. And then the COVID deaths keep happening. I'm going to zoom in and squint, and this is the interesting part, I think. If you zoom in and squint, you can see that the COVID shock, remember, this is estimated from a 77 macro time series. No epidemiological data, no deaths, no nothing, just from like consumption and investment and stuff like that. And it really seems to track quite closely in the COVID, the deaths from COVID. So it tracks it with a coefficient that's going down, but that's also completely consistent with the epidemiological economic literature. At first, like, what the heck is happening? And you have this big response, and then you have a diminished response over time as you start to adjust, as you wear masks, as you have COVID fatigue, and eventually as most people are vaccinated. Okay. So I can decompose a number of these things, and I think I'm going to, in the interest of time, skip over some of these decompositions. Basically, roughly speaking, the COVID factor explains a lot of the movements in the beginning, and then some of these economic factors or traditional factors start taking over. And I'm going to show you just one picture here where this is looking at non-durables consumption, and you can see that a big spike in the blow-up part of the chart. And that big spike in the blow-up part of the chart is in March 2021, which is when the American Rescue Plan stimulus payment hit people's pocketbooks. They said, "This is great. I'm going to go out and buy some non-durables. I guess time to restock on the toilet paper or whatever it is." And that's actually attributed not to the COVID shock. That's attributed to this blue thing. The blue thing is actually the conventional shocks. And so you can see the American Rescue Plan in particular, but all three stimuluses, but especially that one, has its fingerprints throughout a lot of the consumption and employment data. Okay, macro manifestations. Are we back to normal? And we do a number of tests, and you look at the stability. If we turn off the COVID shock, are those lambdas the same? Are the F dynamics the same? Seem to be. Now, you only have a couple of years of data, so who really knows? But it seems, just looking at the tests we have and the out-of-sample stuff, seems to be like we're back to normal dynamics. Have there been long-term shifts? There have been some long-term sectoral shifts. The PCE for non-durables and durables seems to be about 6% higher above some pre-existing trend. Services seem to be a little bit low. Is that statistically significant? Well, there's a lot of uncertainty, econometric estimation uncertainty in estimating these trends, so it's kind of hard to take too hard a line on that, although there does seem to be some lingering shifts. Okay, in my few remaining minutes, I'm going to talk about some of the economics behind this. I think the economics behind why did we buy home office furniture in May? That's not very interesting. The economics of why didn't we go out to restaurants? That's not very interesting. There are actually some pretty interesting things, which is why was the recovery so fast and in those two spurts? Okay. The second one is why is this the first recession, first business cycle in 6 decades that trend reverted? I think that's an interesting question too. So I'm going to spend some time, a few minutes, just talking about that. Okay. Why was it so fast? The first stage, a lot of it was people who were on temporary layoff who went back to work. And so a lot of that is just like, businesses shut down, and then they realize, if you wear a mask, maybe you can come back in, or we'll make some adjustments in work behavior. That happened really, really quickly. It seemed like it was taking forever, but it actually happened really quite quickly in hindsight. There's also the role of the Paycheck Protection Program, which probably brought another 1 or 2% of the workforce back from the status of being temporarily unemployed to being rehired, so that kind of expedited it too. There's some great work by Hall and Kudliak, and so Mariana produced this chart, which is an updated version of theirs, and they point out that this is people who are laid off is the really fast spike, and then everybody else, which is people who don't have a job, they call it the unemployed without jobs, it took a lot longer. But I would note, if you notice, that the turn down there that's in 2021 of the unemployed without jobs, that's a lot steeper than anywhere else. And that's the second half of the recovery, the second fast phase of the recovery from about March through September of 2021. I think that's the most interesting. It's not so surprising that you go back to work on temporary layoff when they reopen your, whatever it is, your company, or you work from home or whatever. But I think the second spurt is pretty interesting. Here's some more plots. And so another thing is, like, this fast unemployment decline also occurred in, like, the long-term unemployed. So if it's occurring in those without jobs in the Hall-Kudliak terminology, it's occurring in the long-term unemployed, and that also is kicking in this period where we no longer, we now been vaccinated, or those who chose to be vaccinated are vaccinated, and we also have the stimulus checks, especially the final one in our pockets. All right, so there's a second reason that this is pretty interesting, and this is from a plot that I just stole from Decker and Haltwanger in 2024, which is an update of their Brookings paper in 2023, and it shows the surge in not just new business applications, but actual measures of new business formations. So there's a lot of opportunity using work-from-home technology to actually do your own new business. Maybe that plays a role in this fast dynamics. If so, that's really interesting, because that says that this new technology, Zoom and all of that stuff working from home, might actually have long-term changes in terms of the dynamics of recoveries. That would be a really big deal if so. Final comment, how much of this might arise from the fiscal boost. So I'm doing another one of these plots, but instead of all the plots so far, well, the most recent ones have been growth rates. Now I'm going to accumulate it up. All right, so let me just spend my, whatever, remaining 30 seconds on this plot. The dashed black line is what actually happened, and this is aggregate employment, and this all deviated from trend. So if you get back to zero, that means we're back on the pre-existing trend. Okay? The red line is the contribution of COVID, and you can see the recession is because of COVID, it's the COVID shocks, and then the COVID thing abates, and then there's some wiggles with the death rates and all of that, but it kind of plateaus out at like minus 0.07. So of the 16% decline, log point, 16% decline in employment, you only come back about half of the way in employment from COVID going away. You still have this hysteresis or base drift, whatever you want to call it. But actually employment goes all the way back. Where does that come from? Mechanically, it comes from the conventional shocks. What are the conventional shocks? The conventional shocks might be relaxation of uncertainty and things like that, but really what it is, in terms of the numerics, it's from the fiscal stimulus. And maybe it's from the monetary stimulus that we were just talking about in the previous session, but it's attributed in our decompositions to the fiscal stimulus. So, you know, where we end up, or where I should say I end up, or where we end up, is that, you know, you're sort of slightly uncomfortable thinking about fiscal stimulus having these long-term trend reverting type phenomena, but long-term here is only a few years, because we're only 5 years after this event. And it seems that plays a pretty big role, maybe up to half of the trend reversion in employment, maybe more like a quarter of the trend reversion in PCE. But that's, and then here's the PCE piece of it. Okay, so that's it. If there's, I bet there's interesting I hope there's interesting conversations about lessons and what this means for future policy, and also what it means for longer-term structural changes.
Thank you. Our first discussant is Mark Gertler.
Okay, looking on the bright side, one benefit of the COVID recession is we've got a nice new instrument, and who better to exploit it than Jim and Mark. Okay, the main theme of this paper is that for COVID, the COVID recession this time was different, particularly for the first year and a half to 2 years. But then after that, conventional business cycle dynamics took over. And I'd like to start by presenting some descriptive evidence to illustrate this. Now, my preferred indicator of the COVID cycle is open table restaurant reservations. This is partly from personal introspections. But the figure, covers 2020 through 2021, and it illustrates 3 of the main points that the authors make. First of all, there was a sharp collapse in spending in a virus-exposed sector, typically a service-related sector, right in the beginning. Over the next 6 months, there was a rapid comeback. And then third, eventually, by mid-2021, mid to late 2021, things kind of got back to normal, okay? Now, from a broader perspective, the next figure looks at the quarterly revenue behavior of all industries exposed to the virus, which I refer to as the contact sector, versus the non-contact sector. And this is kind of like services versus goods, but it gives you a more comprehensive picture of the economy. And the purple line is the contact sector relative to trend. The gold line is non-contact relative to trend, and the black line is the aggregate. And you can see initially the contact sector leads the downturn, and that's reversed. Usually it's the non-contact sector. Then there's a rapid recovery, and Jim spelled out the reasons why: the moderation of the effects of the virus and incredibly stimulative policy. But then third, you kind of get back to trend with normal business cycle dynamics. So notice the economy is back to trend late 2021, and the non-contact sector is leading the way. Okay. Now, of course, the key contribution of the paper is to formally identify the shift in the dynamics. And as Jim nicely explained, what they do is take a conventional factor model and include a COVID-specific factor C, which gets turned off in normal times and then turned on over the COVID recession. And included in the system is equations of motions for the conventional factors F and C. And these factors are going to depend upon their own lags and the lags of other factors and the structural shocks, okay? And the identification of the structural shocks is just through timing restrictions, kind of like the way we used to identify monetary policy. COVID can hit you right away, but the other stuff only affects COVID with a lag, okay? And they get 3 main conclusions. First of all, this COVID shock, it varies with COVID deaths, so that's a measure of intensity. And it also is closely correlated with a weighted spread between goods and services output. And that's this kind of reallocation effect that's a result of COVID. Okay. Second, they find that this COVID shock accounts for most of the variation through 2021. This is both in the aggregate and in the cross-section. And then finally, no persistent COVID-induced business cycle dynamics. The COVID shock kind of dissipates over mid-2021, okay? Now, how can you see what's going on is, let's look at this spread that's correlated with the COVID shock. And it's a weighted spread, so it's the growth in goods minus the weight 3.8 times the growth in services. And the high weight on services mainly means that it's the behavior of services that's driving this indicator. So before the COVID recession, there's no action in this. What happens during COVID is services decline, this indicator shoots up like crazy, and it's going to pick up all of the service-related decline in economic activity, both in the cross-section and the aggregate. But then you need to have things reversed because they're a recovery, so what happens, services begin to grow, but because they have a big weight on services, this indicator goes negative, and the negative indicator is picking up the recovery. And then by about mid-2021 or to late 2021, you see this shock dissipate, and that's when the normal dynamics are going to take over, okay? Now, have three types of comments, and this was an exhaustive paper, so I'm not going to ask the authors to do more work, but this is just in the spirit of what I'd like to see next, okay? First of all, I want to talk a little bit about inflation, because I think this is another important feature of the COVID recession recovery. Secondly, when we think about persistent effects of COVID, I'd like to talk a little bit about costs, whatever that means, but I have in mind something like food and housing costs, because that clearly was a big deal. And then another big deal that I think we can attribute to COVID is the issue of fiscal sustainability or unsustainability, okay? Let me start with inflation, okay? Unlike the 70s inflation, where inflation expectations were unmoored, in this go-around, long-term inflation expectations were pretty well anchored, suggesting that the surge we saw was indeed different from past recessions. Also, what happened kind of fits the theme of this reallocation between services and goods, because if you look at the top figure, you see that it's goods inflation that actually leads the upturn and also the downturn. And Lucrezia and others have made this point as well, okay? Now, if you note, the upturn starts in late spring 2021. This is just as their COVID shock is dissipating. So it's not clear the COVID shock is going to catch this, but it would be interesting to examine. But the inflation clearly is related to COVID. So in the bottom panel, I plot two important factors thought to underlie the inflation. The blue line is the New York Fed Global Supply Chain Index. So this is an indicator of supply shocks, which were clearly important over this period. And then also fiscal policy was a source of demand as well. And it's not clear either the COVID factor is going to catch either of these factors, okay? So they may be treated as random shocks in the model, but clearly they related to COVID, and we might want to give more thought into how we can draw that connection. Okay, next, costs. Okay, clearly this was important. The presidential election probably turned on this issue more than any. Now the CPI, which is the red line, went up over 20% over this period. And I'm going to give the public the benefit of the doubt by that they don't have money illusions. So what they care about is prices, relative prices, not just nominal prices. So first of all, what about wages? Well, the bottom line, which I borrowed from Eric Hurst, plots real wages. Okay, real wages declined for a while, okay, but eventually they came back from where they started. So real wages now are about where they are at the start of the COVID recession. But don't forget, there's a trend of about, before a pre-COVID trend of about 1% and a third. So wages are actually down now about 5% relative to trend. Okay, and this would be something interesting to investigate why there's this persistent effect. Also, food was in the news, incredible amount. What about food prices? Well, food prices are up maybe 5 to 6% relative to the overall CPI, so they're up even more relative than the CPI prices relative to wages. The story is that wages of grocery workers are up, and also commodity prices are still elevated. Okay, so that's something we would want to look in drawing out the effects of COVID. Also, what about housing prices? All right, in this picture, I plot two indicators of housing prices. One is the blue line is housing prices. Okay, the red line is the 30-year mortgage rate. And if you look to the right side of the graph, mortgage rates are really high, housing prices are still really high. How is this connected to COVID? Well, look around the COVID recession. You see mortgage rates drop to the record lows. And this was the incredibly, or at least partially, the incredibly stimulative monetary policy. Not only the conventional policy, but as Annette showed, the unconventional policy was really pushing down rates. And this could have been a factor driving up housing prices, okay? Then what happened? We have the inflation, and the inflation induces the Fed to raise interest rates, so mortgage rates are high, and housing prices, well, they've softened. They haven't really come down all that much. So housing costs are still high, and I expect we'll learn more about that from the next paper. Okay, finally, what I'm going to refer to as fiscal unsustainability. The authors note that the debt, one effect is that there's been a persistent increase in the debt to GDP ratio, and that's the blue line plotted above. But the other thing that has happened is that interest rates have gone up. Real interest rates have gone up. What I'm plotting is the real long-term bond rate, the 10-year rate, and I'm using the break-even inflation rate to measure expectations. So you see, before the COVID recession, long real rates were under 100 basis points. They're now up to about 200 basis points. Short rates are also higher than before COVID. So what's the net effect? Mix that with a high debt to GDP ratio, and you see that government interest expenses have rocketed. They're now the biggest biggest government expenditure. They exceed defense expenditures now. And all the craziness that's going on in Washington with Doge and so on must bear some connection to the bottom picture. So, okay. Okay. All right, so concluding remarks. Great paper. There's lots of follow-up work to do, and it would be nice to see the authors or somebody else kind of attack inflation and costs and so on the same way the real sector was attacked in this paper. Okay, thank you.
Our second discussant is Lucretia Reichlin.
Thank you. It's a pleasure to be here. Thank you for inviting me. I always discuss Stock and Watson papers, so I'm an expert. That's my specialization. And this is a great paper, analyzing a lot of data and trying to get the robust fact. And this is an approach that I really like, because it's instead of trying to identify the unidentifiable, I mean, you just look at correlation in a very, thorough way. Well, what is the message of the paper? Mark already talked about it. COVID recession and recovery have been exceptional in many ways. Duration, debt, speed, and sectoral shift in consumption, employment, and production. And this exceptionality lasted for about 18 months until mid-end 2021. After that, most variables are back to pre-COVID level. And it looks like that there haven't been long-term scars, although it might be a little bit too early to say, but, and there are probably costs, as Mark emphasized. Now, this is consistent with a lot of the experience of the forecasters. So just let me give you one slide of my own experience with the COVID recession. This is the room mean square forecast errors on a kind of rolling, 4-quarter rolling window of a nowcasting model, so which is about estimating current quarter GDP, looking at a lot of data and updating in real time. You see, this is the root mean square forecast errors are pretty much flat. When COVID comes, the model kind of collapses. And if you don't change the model, which a lot of forecasters do in the middle of the storm, you just go out of the market, but then, gradually you go back, okay? So the errors, converge to pre-COVID quite pretty fast. This is also consistent with some work by Lenz and Primiceri, which is more econometrics, and is trying to say how should we deal with the COVID period when we estimate a model. So basically what they say, I mean, they do something a bit more sophisticated, but essentially what they say is put a dummy. Okay, put a dummy for those 18 months. And if you put the dummy and then you estimate a conventional VR, so this is the impulse response function from a standard deviation shock to an employment equation on several variables, so you get the usual impulse response function, like if nothing else had happened. Okay, so that, and it's very consistent, I think, with the message of this paper. Now, so you can think of two type of recessions. I mean, I like to, this is a stylized. One is a type of recession, I'll call it more crisis. This is, think about a financial crisis, so that there is a recession, but you never go back to the trend. So there is a permanent loss of output. That was the financial crisis in the US and in Europe. This has also been COVID in Europe, not in the US. And I think that this distinction is maybe food for thought. And this is the COVID recession. You go back to trend. And actually, as they have emphasized, we haven't had a lot of those recessions, even if this is what most economic models think a recession is about. Okay, that is something temporary, and that you go back to trend. Now, so the U.S., so the COVID recession in the U.S. is different, and I think if I read the paper after I have read it in many different ways, then the first version was not that clear, but actually I think we converge on the same message. It seems that a lot is fiscal. And here you see consumption, government spending, GDP, and investment for the EU and for the US. The blue is actually the financial crisis. The kind of pinkish is COVID. You see here that GDP, investment, consumption, government expenditure, you remain above trend, while this was not the case during the financial crisis. And in the EU, we have done better in COVID than the financial crisis, but basically we don't go back to trend. We remain slightly below, especially for what concerns investment and consumption. Now, you also see there, I mean, the same picture that both the authors and Mark show, that government expenditure has that kind of funny look of the fiscal packages, that especially the second and third fiscal package. Now, so if you look here, is from the paper. So this is the macro pictures. So what is really, so you see, this is comparing this recession in blue with previous recession in the US. You see, this again, the main message that, by, end of 2021, you go back to trend. And you're in the middle of the pack if you compare it with the previous recessions. The kind of characteristics of this recession has also been this, these big peaks, which is the government transfer payments, which then you can see also in the personal income series. Now, what is the logic of the methodology? So business cycle fluctuation through the sample are captured by these common factors. These common factors are really a bit of a black box, but they are interesting because they capture the co-movements of a lot of time series. And then if there is one thing we know about a business cycle is that everything moves together, okay? So that the three factors capture what we think are the systematic features of business cycle, and of course in there is a policy, the structural responses, the structure of the economy. So it's a big, we put everything there, but we capture the regularities through those three factors. And then there is this orthogonal component, which is sort of a dummy, but is something more sophisticated than a dummy. But it is something that is only switched on for 36 months, and this is the COVID factor. And then once you have the factor, you can rotate them and get the shocks and interpret the shocks and do impulse response functions, do variance decompositions, and use the usual toolbox. Okay, so now this COVID factor, what is it? I mean, we don't know what is it because it captures everything. It captures the death, it captures It captures the fact that also the first fiscal package, it probably captures also, the exceptional monetary policy phase one. It captures the fact that demand goes down and so on. But it's very correlated with the reallocation features which characterize COVID. And okay, here you can see it, I think, more clearly. This is, this is just the ratio of service consumption to good consumption. Okay, they use other similar variables, also employment. You can see something like that. But what is interesting is that normally service is less cyclical. And so actually, that ratio goes up. It went up during the financial crisis, but actually here it moved on the opposite side. And this obviously because the economy was closed and all the specific characteristics. But then it goes back to previous level. So the first question is, okay, so what's going on here, and what is the role of the fiscal policy in the recovery? So here, I think this is, I'm taking, selected pictures from their paper. You see here the factors. So in red, you see the COVID factor, the specific COVID factor. And you see the fit in some observable variables. So here I pick government transfer payments and personal income. And you see the fit of the COVID factor. And then you see the fit of the non-COVID factor. So in blue, in red, you have the COVID factor and the conventional factor. In blue, only the conventional factor, business as usual, so the historical characteristic of the business cycle. And in black, you have the data. So you see that if you want to explain government transfer payments and personal income, the COVID factor is essential to get the first peak. That's the first fiscal package. And, but actually, the second and third fiscal package, the ones in 2021, they are not captured by the COVID factor. These are read by the model as shocks to the conventional factor, shocks to the business cycle. Now, whether this is a shock or not a shock, I mean, it's huge. This is systematic policy, but anyway, this is the way the model reads it. And, the same for personal income. So then when you look at the shocks rather than the factors, so the shock to the factors, you have the other picture there, and then you have that the COVID factor is explained by the COVID shock, whatever it is. I mean, this is an aggregate shock that explains the bulk of the variation during that period. The first factor and the second factor, you can interpret it as employment and consumption, okay, to get something less, obscure. But you can see that to explain employment and consumption, what really, you really need, the COVID factor doesn't explain anything anymore, the red. So what explains that dynamics is the blue, which is the shocks to the conventional business cycles. And this is true for employment and also for consumption, but especially in consumption, is really about the second and third fiscal package of 2021. Okay, so the first 18 months is all explained by the shock to the COVID factor. After late 2021, the shocks to conventional factor explain the dynamic of all the key variables. And this is really about the fiscal shock. Now, this is completely unreadable, but luckily Jim put up the same chart so that this is the shock to the observable. If you like to think in terms of observable rather than factors, you can see that the conventional shock explains most of total consumption after the end of the first phase of COVID, of the COVID recovery. This is consistent, again, with some of the new paper coming out and try to see what is demand and what is supply. This is from Giannone and Primiceri, in which they look at the composition of US GDP, what is demand and what is supply. You see that after the end of 2021, it looks like there is a lot of demand, okay? So that I think this is another way of looking at the same thing that comes to the same result. Okay, now, correlated with Mark's remarks, what do we learn from price dynamics? I mean, we know that then we got inflation, okay? So this is all good. Fiscal really helped, consumption, employment, fantastic. But then we got inflation. and maybe issue of fiscal sustainability, so who knows. Okay, so I think what is interesting about this inflation, however, I mean, less than the obvious point that we had inflation, that is that because we have both a reallocation shock and a demand shock, we have both relative price change and kind of pure inflation increase. Mark, you wrote a paper a long time ago with Ricardo Reis about this distinction. Inflation is partly relative price and partly pure inflation. And here, if you see the distribution, here you have the distribution of sectoral output, the entire cross-sectional distribution over time. And here you have the distribution of price of inflation, sectoral inflation over time, with the different colors. I mean, I don't know how, what you see here. I mean, I had a movie, but then it was too complicated to put it in PDF. So, okay, what you see is that you have, when the recession comes, this comes with big reallocation. So there is both the standard deviation and of the distribution and the mean shift to the left. That's the recession. And actually, the dispersion of prices also increases. And so the dispersion of prices starts before the big increase in the mean. And it persists. And of course, it persists because prices are rigid downwards. So that as the economy go back and start growing again, so that you go back to the left, you go back to the right, then the cross-section, the inflation remain persistent, and partly is because of this kind of, aggregate demand, pure inflation, but partly also the persistence is also due to this dispersion, which is driven by the fact that the economy is adjusting, and so some relative prices has to go through. So this is what Mark called the good inflation. Okay, so that okay, I have to conclude. So okay, now no long-term scars. I have more questions than things to say. One thing is what happened to the labor market, and I think that even if you look at some of the charts that you have in the paper, you can see that it's not quite right that there is no long-term scars. You see that, for example, here you have the historical decomposition, COVID and non-COVID sources. You see that the COVID cannot really explain, okay, the decline in unemployment. You need the conventional factors that may be fiscal, but also labor force participation. The COVID shock seems to be permanent. And so the COVID forces bring down labor force participation on a permanent basis. This is actually your result. And so you need a bit of fiscal to push it up, okay? But so we don't, I don't know whether this is going to be permanent or not. And then, of course, what happened, and this is not in the paper, but it is a question maybe that is important to, to understand the difference between the US and the Euro area. I mean, both in the US and the Euro area, we had a big jump in digitalization. This is from the US Census Bureau, and this, you see it's the e-commerce sales as percentage of total quarterly retail sales. You see a big jump. We see the same data in Europe, but actually, productivity in Europe and in the US have had a very different dynamics. So could it be that fiscal is actually, the running the economy hot is also helping, the economy to avoid this kind of, productivity bad performance that we had in Europe? Of course, this has to be weighted with the issue of sustainability that Mark stressed. Thank you.
All right, a lot of name tags up. Let me start with Sebna.
Thank you so much. It's a great paper and very insightful discussions. So I want to go back to the point Mark made and the importance of that. So the importance of matching the inflation dynamics and at the same time real wage dynamics together with the cross-sectional patterns. This is extremely difficult. And I really applaud authors try to get through all this with the COVID shock. So we have been working on this since 2021, and I believe our 2022 Sintra paper is the first one that made the point that fiscal stimulus in a supply-constrained world is going to be inflationary relative to a world where you do the same fiscal stimulus, but the supply is not constrained. So getting both to the demand and supply side at the sector level, exactly as Mark's saying, in our two papers, both the Sintra paper and the later 2023 pandemic inflation paper, we show that actually you can match the inflation and the real wage, the increase and decrease, both in the aggregate and cross-sectional. And you can also match the difference between Europe and US. I mean, US fiscal is going to be more important, which is also in our AEA papers proceedings in 2023, but in Europe, not the case, which again, fiscal is going to be less important in Europe, but they experience the similar inflation. So I think what Mark said there is very important to get both of those patterns.
Mike Kiley?
Thanks, great paper. I would just observe that 3 words or phrases that are very commonly discussed here at BPEA are not a part of the paper, but raised by the paper, and that's a high-pressure labor market, scarring, and inflation. And so on the trend reversion, how much of it is owing to a high-pressure labor market, and how much of the cost of that is inflation, or was the inflation just orthogonal? And I think that's a really important question.
David?
There's there's incredibly interesting paper in discussion. I want to pick up, I think, on something that was in Lucretia's comments, which is there's kind of a disconnect between sort of the story one tells intuitively and what comes out of the dynamic factor model. So in some sense, the entire, all 3 fiscal stimulus packages were a response to COVID. They wouldn't have happened without it. So the story one's inclined to tell intuitively is COVID hit, that generated the fiscal response, then we got inflation, we got all the way back. And then one would ask the question, if we knew one could partial out the effects of fiscal policy, how much of getting all the way back, and the inflation was because of the fiscal response, but that would be part of the transmission mechanism. The dynamic factor model doesn't give that story. It says we were hit by COVID, which had, for example, caused a permanent fall in output, and then we were hit by some fiscal shocks that conveniently offset that. And my question is am I playing fast and loose because I have complete degrees of freedom because I'm making stuff up? Or is the dynamic factor model missing something and not telling us the story that is, in some sense, your eyes tell you is the right one?
Doug?
Thank you. Thanks to Jim and Mark for a very interesting paper. I wrote a related paper last fall with Karen Dinan for a project at the Peterson Institute on the causes of the COVID-era inflation. And we focused on fiscal policy. Our approach was not as econometrically sophisticated as that of Jim's and Mark's, but we did conclude that the timing and breadth, other characteristics of the surge in inflation mapped most directly to the fiscal stimulus. And let me just highlight 3 points that we made in the paper that may be of interest. One is that there is a conflation in a lot of the discussion about the COVID inflation surge of shifts in a supply curve, so what I think we mean by a supply shock, and movements along supply curves because of shifts in demand. And so, for example, the supply chain index that Mark used, that many people have used, is not, in our view, a measure of supply shocks. It's a measure of the stress between the quantity demanded and the quantity supplied that was increased both by reductions in supply and increases in demand. And throughout both the professional literature and the non-professional literature, these ideas kind of run around together in a way that I think has confused the debate. A second thing that we did was to look carefully at forecasts made by the Federal Reserve members, the CBO, and private forecasters throughout the course of the pandemic and the recovery. If you look at the forecast in early 2021, before the American Recovery Plan was enacted, those forecasts expected pretty strong recoveries to continue in 2021 to bring the economy back close to full employment by the end of the year. If you look at those forecasts after the American Rescue Plan, they really expected an overshooting of potential output in CBO's measure, the largest excess of output over potential output in the history of CBO's construction of that gap. One might normally have expected that to then lead to some increase in inflation, and that was not, in fact, in the forecasts of the private forecasters or of CBO or of FOMC members. And I think that was presumably just an extrapolation of a Phillips curve that had looked quite flat over the range of output gaps that we had actually seen over the previous decades, an extrapolation out to an output gap that we had not seen before. And it turns out that the aggregate supply curve, the Phillips curve, actually is curved, not straight. And the third thing that we finish our paper with, but goes back to your comments, Jim, and which are the lessons to take from this. And I'll highlight one of them, I think, which is most of the concern about countercyclical fiscal policy, I think, had been whether it could act fast enough and whether it would act on large enough scale. The fast enough point is a long-standing issue in textbooks since I was an undergraduate. And the scale, I think, concern came particularly out of the recovery in 2011 and 12 and so on, when by most economists' lights, far too little fiscal stimulus was applied, given the output gap. I think we've now learned that one can make errors on both sides of those things, and that having appropriate countercyclical fiscal policy is not just about turning it on and doing enough of it. It is also about turning it off and not doing too much of it. And I think that highlights the potential value of stronger automatic stabilizers, or more responsive automatic stabilizers, which is to say that you could turn when the American Rescue Plan was being developed, despite economic forecasts, there was a lot of uncertainty in the world about how many people would be vaccinated, how it would work, how the recovery would play out. So the idea to do more stimulus was not crazy. On the other hand, it turned out, ex post, I think, to be too much. And if you had automatic stabilizers in place rather than just a preconceived package, you had a better chance of turning things off and not doing too much. I'll stop there. Thank you.
Steve?
Yeah, very interesting paper and discussions. I think the analysis overlooks another distinctive aspect of the COVID recession that sets it apart from other recessions and also helps to explain the trend reversion feature. So you emphasized rightly the Hall-Kudliak point about the huge surge in temporary layoff unemployment and its rapid recovery. But there was also a rather extraordinary withdrawal from the labor force in reaction to the COVID shock. And that also unwound, but it unwound much more slowly than did the part of the labor market phenomenon that Hall and Kudliak suggest. And it's interesting that the story that Jim told about Mark catching COVID and dying, that affecting Jim's behavior. Oh, the other, yeah, sorry about that. The other way around. Yeah, that doesn't actually feature, though, in your explanation of what's going on with employment and the labor force participation rate. So I have a paper on long social distancing with Jose Maria Barrero and Nick Bloom on the withdrawal of people willingly from the labor force because of either concerns about their own health or also concerns when they lived with somebody who was health compromised and they didn't want to give them COVID. We use a variety of different empirical approaches, different surveys. They all suggest that something on the order at their peak of 2 or 3 percentage point reduction in the labor force participation rate from social distancing, intentions, worries. Unfortunately, the different methods differ as to the timing of when things unwound, but they do suggest that by early 2023, they had mostly unwound. But it's a much slower unwinding than Hall and Kudliak. Now, you don't see this in other recessions. Obviously, you don't see the COVID part of it, but it's part of the reason we got back to trend, in my view, in terms of employment rates. The phenomenon is very much concentrated among less educated people, older people, and those who are living with health compromised people, according to our analysis, exactly where the concerns about infection worries would be most important. Now, it relates to David Romer's comment earlier in that I don't have all the details of your model and analysis in my head,
but it appears that part of what you might be attributing as the recovery due to the fiscal stimulus could be just this natural return to the labor force by people who eventually became concerned, and according to our analysis, they reacted slowly to the COVID death rates, as you might expect. They eventually came back to the labor force. So that's kind of point one. And if I could make a separate point, it's somewhat related, but you rightly also stressed, in my view, the fact that the remote work technology and maybe digitization of some activities has facilitated new business formation. But there's another thing which is also, I think the jury is out as to how big this effect was. But remote work has expanded labor force participation and employment opportunities for certain groups that previously found it hard to work or not very attractive. And that obviously includes people with physical impairments that limit their mobility, or people who have other conditions, sometimes psychological or cognitive conditions that make it hard for them to work directly. And then finally, people who live in remote areas where the labor market opportunities just don't meet their skill sets, or people facing joint location constraints. All of these people, all the people in these groups I've just listed have expanded labor force participation opportunities because of the shift to remote work. There's some emerging evidence, Nick Bloom has a paper on this, that in fact we now may have higher labor force participation rates in these certain groups than we did before as a consequence of everything that was triggered by the COVID shock, which would also help explain why we kind of got back to trade in a way we didn't in previous recessions.
Catherine?
Maybe just picking up to some extent on Steve's comment and really building on Lucretia's comment at the very end of her discussion about possible lasting effects on the labor market that aren't picked up in the focus on the aggregates that were emphasized in the paper. There are a number of things that I think one can point to in the labor market that appear to have been affected by COVID and to have had more lasting effects. One that was already alluded to is the big increase in new business formation. You talked about that, Jim, as a possible explanation for the rapid recovery in employment, but it seems to me that that's of interest in its own right as an outcome. Steve was just talking about work from home, which seems to have persisted at significantly higher levels and may have had some run-on effects on labor force participation. A third thing that I would point to is some evidence, at least in data from the current population survey, that there have been lasting effects on how much people are working, in that there seemed to have been a continuing decline in weekly hours of work that I think plausibly is attributed to effects from COVID that's led to changes in people's behavior. So I think the paper is great. I just think if you expanded the set of outcomes that you were looking at, there might be some other things where you would see more evidence of actual, I don't want to call it scarring, but actual persistent changes in the labor market.
John Heltinger?
I'm going to add a little bit and build on this, the role of business formation. And just a couple to emphasize things that are very distinct about this last 5 years for business formation, and some of it's been alluded to already. One thing is, what do we typically see in recessions is we see business formation fall, and actually persistently. It's very slow to recover. It was, especially that was true in the great financial crisis, but Steve and I have worked and shown that that goes all the way back to the 70s. Instead, in this case, while there was a very short run decline, it actually, business formation started to spike as early as June and July 2020. And so this may be related to the remarks about contributing to the rapid recovery. But it doesn't look like this was, at first, by the way, when we all saw this, we thought, oh, this is transitory. There were market opportunities, et cetera, that were just very different in this period. But the nice thing about business formation statistics, it's real-time data. The latest data is out through February 2025. we're still 30% higher likely new employers, over 50% higher likely new non-employers in February 2025, stayed really high. We're still trying to figure all this out, but there's a couple of things, again, related to the discussion today. One sector that's really taken off, and again, we thought maybe is this transitory or not, but it's persistent, is e-commerce. E-commerce has just exploded in terms of new business formation. Another sector that's really exploded is often what we attribute or associate with high-tech kind of activity, the information sector and professional scientific and technical services. And some of that, interestingly, by the way, is AI. We clearly see that. But I think some of it's what other people have talked about is the impact of digitization in terms of the ability to go out on your own. I think Jim brought this up and other people as well. So here we are in 2025, and something that we have not reverted to trend is business formation. We're still really high.
Bob Gordon.
Lucretia brought up productivity briefly, and I wanted to mention, I wanted to put the 2020 COVID experience about productivity in context. Going back to Okun's law, the old idea was that a 1% drop in output in a recession would be divided up, 1/3 increase in unemployment, 1/3 decline in productivity, and the other 1/3 divided up between hours per employee and labor participation. So what happened in 2020? After a trend of business productivity growth of only 1.1% between 2010 and 19, all of a sudden productivity in 2020 grew at 5% in the 4 quarters of 2020, and then it turned negative in 2021 as the economy recovered. What was going on? Is that something uniquely connected with COVID? And the answer is no, because exactly the same thing happened in the great financial crisis. Productivity in the 4 quarters of 2009 grew at 6%, and then suddenly slowed down. Our diagnosis in a paper that is floating around is that in the great financial crisis, business firms were so panicked that they engaged in, I think I originally got this idea from Christy Romer, in excess layoffs. They just fired at random too many people. And if you look at it by industry, it's actually concentrated in the 3 industries most affected by that recession, which were construction, manufacturing, and finance. If you isolate the recession over layoff effect and then take the obvious fact that these people would eventually be rehired, it turns out that you can explain entirely why productivity growth was so slow in the decade of the 2010 to 2019 period. And so we think the same thing happened in 2020. In fact, you can simulate equations that are run up to 2019, and then it turns out the COVID recession pretty much mimicked the excess layoffs of 2009. So the question is why? One obvious thing we can do, because we have quarterly productivity data with hours and output separately, is to look at the 3 big divisions of industries that turn out to now be the way to look at the economy. And that is work from home, the computer-based services, contact services that were so strongly affected by COVID, and the remaining part of the economy, making goods, which is the part where demand surged relative to supply. So that's ongoing work, but I thought the connection between the 2020 and the 2009 experience suggests that something more fundamental is going on.
Fabrizio?
Great paper, great discussion. From working at the Fed, there's one thing that changed dramatically pre-COVID and post-COVID, and that's inflation and real interest rate. We were, before COVID, was like the interest rate was 0, long-run forecast was always 0, and now we don't know. We're going to go 2%. So that's a big change, really. And I was shocked by, you showed that the business dynamic didn't really change after that, and I was wondering whether, yeah, maybe I think the second moment, but this is a big change in the first moment. I was wondering whether your methodology can capture that and can give a little, it's very, very useful for us to understand, you know, if there's a change in the level of real interest rate after COVID, and if that, what causes? The fiscal, is it like productivity or whatever it is, but that would be super useful. If empirically, give some guidance for that.
Ben?
A couple of comments on Doug's remarks. One about the output gap. I'm looking on my phone here at Fred's CBO output gap, which never goes above 2% according of GDP in any time since 2020. It was 6% in 1966. So I'm not sure what's going on there. The second point I'd make is that...
So Ben, that you're looking at the actual as it unfolded. What I was referring to was the forecast the CBO made after the passage of the American Rescue Plan.
I'm looking at the actual, which is what should affect inflation. The second thing is the idea that supply chain issues were really demand against a limited supply. If that's true, you would expect domestic industrial production and capacity utilization to be at maximum level, right? In fact, I know, at least in the case of cars, that U.S. domestic auto production fell below normal at the same time that auto prices were rising and inventories were declining. So that's inconsistent, I think, with that story. So I think there's some issues there to be resolved.
Luis?
I also want to follow up on Doug's comments. When we talk about the lessons learned, if it's really true, if you're right, that fiscal is what got us back to trend, and if that would have persisted for quite some time, then the lesson should be fiscal is incredibly valuable. We did too little before. We did enough now, and if you would do a welfare calculation, you would have said it was clearly worth it. But I don't think that's the lesson that's going to be learned. The lesson that's going to be learned is fiscal leads to inflation, don't do it. So I'm really worried about the next time that we will actually shy away from fiscal. So I'm wondering if there's a way to use the model at all to gauge what a right-sized fiscal policy might have accomplished. Could we have most of the benefits of getting us back to trend, or all the benefits, without the inflation? And really to try to make that point about even a welfare calculation of how much fiscal, how valuable it was, is not the story that we're going to come out of this with. So I would encourage you to try to push that story.
Mark?
Just two quick observations. One on the fiscal stimulus. It probably was a bit longer lasting than just the checks that came out, because there were child tax credits that were paid out over the second half of 2021 and so on, and claims for employee retention credit and so on. And then second, the scale of the fiscal stimulus was probably greater than policymakers expected, because things like the Paycheck Protection Plan and employee retention credit were gameable and subject to fraud going on, and so probably was more fiscal stimulus than at least Congress intended.
Jen?
Seems like we're turning to fiscal issues, but I know this is rude, but I want to compare the results here to your paper, also here on the global financial crisis, because we're talking a lot about fiscal and what might have happened, what might happen in other episodes. And you considered that in your paper, examining the global financial crisis, and concluded that a lack of fiscal was not an explanation for the slowness of the recovery from the global financial crisis. So I guess the question is to compare the results in the two episodes. And then a second, this is actually related to what Mark just said, is another explanation for the strength is also that this type of shock might have been more amenable to a fiscal intervention than something like the financial crisis. So the fact that it was a very sharp decline. So things like Debbie looked at in her paper, where there was mortgage forbearance and there was a lot of rent forbearance, are fiscal interventions, but they help get you over a short episode, but they were not used in longer episodes. So I wonder if you could take a broader look at the fiscal, or give some more comments based on your previous paper and also what might have been different in this episode.
Steve?
We haven't seen the long term yet. A whole generation of students missed a large part of their human capital formation, and it has not been recovered, according to Tom Kane and his colleagues. So let's not forget about that. And the second question I have is there was more people died in 2021 than in 2020 because of these, I think it was the Omega variant, and that somehow that doesn't show up in your COVID variable. Why not? That's all.
Okay, let me finish it with a question of my own. So I thought the second fast phase was a very interesting part of the analysis. And so you argue that the F dynamics are the same before and after. So something special about the F dynamics is not explaining the second fast phase. So I guess it has to be special shocks, special F shocks that are explaining the F dynamic, sorry, the fast phase in the second fast phase. Is that my correct interpretation? Anyway, I think we can turn it over to the authors. A lot of questions, I guess.
Mark has them all.
I'll start, and then Jim can chime in. Let me step back for a minute and just mention why I was interested in this paper, and I think why we started working on it, which is, we were interested in business cycles, and sure enough, we've had a lot of business cycles and recessions, each of which was caused in some sense by something else. It was by something different. It was oil. It was a great financial crisis. It was something else. And what have we learned from those? Well, sure enough, in some sense, those were all different, but they were all alike in the sense that one can explain them through, a small number of channels. And, here represented by a small number of factors, but in terms of a structural vector autoregression or something of the sort that been developed a long time ago, right? In some sense, recessions and recoveries are all alike, different shocks, but all alike. And the great financial crisis, as Jan mentioned, Jim and I wrote a paper, about that for this venue several years ago, and surprisingly, we found that held even for that. The shocks were different, but the channels were the same. This time, I didn't know what we would see when we looked at COVID, but in fact, we saw something, incredibly different, that in fact, these sort of standard channels didn't work, and hence we needed another channel, which was transitory, but explained, most of the variability. What came out of that is if you're doing econometric analysis and you're interested in studying business cycles and stuff like that, and you're not interested in COVID per se, how do you handle this, going forward? And I think, what we've learned is, including another variable like deaths, right, is not going to be important because the timing of deaths isn't exactly right. That some variable like your contact versus non-contact employment, or this services versus goods PCE spread turns out to handle that. I did want to say something. A lot of when we do this decomposition in the papers, Jim showed, is it F shocks, these traditional shocks, if you will, or C shocks, and looking at, what was happening in early 2021 and beyond 2021, obviously those F shocks were coming from COVID, and our model does not capture that, just because we have to have, sort of very short lags there. So it's clear the interpretation of those is they're really COVID related. I think Jim and I both agree, and from what I have heard over the last half hour, everyone here agrees that, the most interesting part of this COVID episode is not what we talked about, the recovery here, but long-term trends and how the recovery is going to unfold, over the long term, which, as Stephen mentioned, we haven't seen yet. And, our results here are obviously completely preliminary, and all of the various factors that people have talked about, are going to be important to look at going forward. We're not going to do it in this paper. Someone should do it 10 years from now when we can look back and sort this out.
Thanks. So these are fantastic comments, and I'm not going to try to go through each of them one by one. I do want to just say a couple of things. So it's quite interesting. I think Steve Braun, why don't we see more COVID response or more stuff going on for where the really big death waves were, which was Omicron was actually, I believe, if I recall correctly, the biggest of the death waves, and that was around like January of 2022. So that was really quite a ways into it. And this really relates back to this EPIEC literature where there's these various estimates, and this was in the Atkinson paper, for example, at Brookings, not too long ago. And what you see there, right, a year ago, I think, and what you see in that literature is that basically there's this COVID fatigue, and especially the Omicron wave occurred after everybody who wanted to get vaccinated, right? I mean, about 2/3 of the people got vaccinated. The other third said, I should be careful with my words, decided not to get vaccinated. And so they were the ones who were vulnerable to death, but they were also the ones for whom they were sort of not really reacting to the COVID pandemic too much. So it was just pretty much really small. You could see the movements in the data. It's there, but it's quite small. So I think that there's very common sense interpretations in terms of what was actually happening. I'd like to just make one comment on these shocks, and this is going to sound so pedantic, but this gets to David Romer's comment. I would argue, especially early in the pandemic, it's not like we had an uncertainty shock, and it's not like we had a reallocation shock, and it's not like we had a fiscal shock with the very first stimulus, the CARES Act. We had one shock, and that was the COVID shock. And it turned out that as a result of the COVID shock, there was a ton of uncertainty, and there was retraction, and people stopped spending money, and there was a lot of self-protection behavior that led to shifts in how we consumed and how we worked, and it led Congress to go pass this big stimulus bill, but there was one shock. There wasn't a whole bunch of shocks. I know that sounds pedantic, but actually I'm sort of sticking to the structure of the model. That explanation doesn't work for the later shocks, and although clearly we wouldn't have had that conversation had COVID not happened, by the time we passed the American Rescue Plan, it was like COVID, people who want to get vaccinated were already getting vaccinated, and we'd already had this big COVID fatigue, and the COVID economic behavior was really quite muted, and certainly the demand side of that COVID economic behavior. So now that was a train that left the station during, no later than the Georgia senatorial election, and probably a little bit before then. And it's the economist standing in front of the train. Good luck, So that happened, but it's not directly in a quantitative sense explained by these COVID shocks, which had largely dissipated. That does get to this bigger question, which many people asked about. How does one think through the merits of the final two stimuluses, but especially the American Rescue Plan? And we don't take a stance on that. We're just simply pointing to this one set of effects, the family of things you would discuss about, was this a good plan? What do we learn just from this plan? That goes way beyond the scope of this paper. That involves the inflation, it involves the debt GDP ratio, it involves political economy. There's a ton of stuff to discuss on that. So we're just going to contribute to saying that it did seem, whatever, mechanically, to bring us back to that pre-existing trend as one of the many things that one would want to discuss in this context. I think that Mark said the remaining things, and this isn't an inflation paper because we have a 45-page limit, So. Yeah.
Let's thank the panelists. So we'll break and start up again at 12 noon.
Yeah, that was good. A lot of interesting stuff.
We are doing joint work on other issues. So this was an interesting way to look again at stuff we've covered in the past. And I know I learned a lot, and I think I speak for Ed that he learned a lot because things have changed in a big way. In a 2018 JET paper we wrote, we basically, there are three parts of America in terms of housing markets. There are supply-constrained coastal markets, which have very, very high prices and don't build anything, basically, or really minute amounts. There are declining, primarily Rust Belt cities, like the one I grew up in Dayton, Ohio, which produce roughly the same amount of housing as a percentage of stock as Los Angeles does, but that's a demand story, not a supply story. And then there was the rest of the country, which was the bulk of the country, particularly the Sun Belt, which was producing copious amounts of housing and was modestly priced in ways we'll discuss. Since that work, coming back to it was not just fun, but interesting. There are some longer run changes that we see have happened roughly since the turn of the century, especially in Sunbelt markets, where they look to be more restrictive, and we'll talk about that. Now, one of Mark Gertler's comments in the previous paper, he said you'd learn about, what had happened to housing markets in terms of recent, COVID and post-COVID works. You actually won't. We're going to focus really on these longer run issues. It's not to say they're not important. Both COVID and recent Fed interest rate policy clearly are impacting housing markets and just in two obvious ways. COVID increased the demand for larger amounts of physical space. Housing's a durable good. It takes a while to build it, to get it permitted and the like. So you see those effects in recent data. The Fed interest rate policy, mortgage lock-in, right? If you have a 25% drop in mobility, it turns out in a given year, between 85 and 90% of all home purchases are out of the existing stock. They are not purchases of new homes. If you take 25 to 30% out of that, that's a big drop. In listings, and that means you're biased towards new homes and the like. So that stuff's important. We're basically going to argue here that while important, it's not as important as these longer run changes are, because they could be really, really long run, as it were. So here's the roadmap. If I get through this, I know I'm between, you and lunch. If I get through the next two pages, you kind of understand the paper. Start with key facts on prices and quantity. The key facts are that real prices are at historical highs. It's true both nationally and in a number of markets, including some Sunbelt markets we're going to focus on. I should also note there, we're going to talk about all housing units, which include owner-occupied and rental. When I talk about prices, I mean house prices of owner-occupied product, not rents. That's important. Raven and her colleagues at the Fed have done interesting work showing, just because house prices are going up doesn't mean rents are. We're focused on prices when we talk about P. When we talk about Q, we're combining the two. Second important fact is the rate of net new supply increase has shrunk over time. It's clearly converging across types of markets. I'm going to show you a slide in just a minute that if I didn't label the series over time, you would have it would be impossible for you to tell which one was Los Angeles's net new supply rate and which one was Dallas. They've converged and slowed down. Some other data, if I get to it, if I have time, the slowdown in production and convergence across markets is occurring in the suburbs, not just the center city. So the paper's then going to take those facts and argue that supply-side conditions are becoming really more important, particularly in the Sun Belt. That's the news in this paper. Los Angeles is still supply constrained. Boston is still supply constrained. Detroit, Cleveland, and Dayton, Ohio, where I grew up, are still suffering from low demand. What's new, though, is the changing supply-side conditions in the Sun Belt. And we're going to argue that it's the strength of the relationship between house price, how expensive are you, and the supply of new units, that if you look at that, you're going to be able to tell whether that supply schedule is shifting over time. And what we're going to find is this next to last bullet: new unit supply is less correlated with price over time, even in Sunbelt markets. What that means is, in the Dallases of the world, they used to build a lot in low-density, high-price census tracts, which is what we're going to use. They do it much less frequently. Now, it's a very big change. We're going to examine a density wall hypothesis, too, that, you just hit some level of density and the population says no more. You can see that in some of the data and in some of the analysis, but it's not the dominant factor. Okay? Now, two other supply-side factors I want to get to, because I'm not going to mention them the rest of my 9 minutes. Rising physical construction costs are an important change to the supply side. They're up roughly, it varies a bit across market, 30% in real terms. That's a big deal for affordability. It's the last thing I'm going to say in this presentation. Second, it's a 45-page paper, and we spend 6 of it on this second point, which is the shock to the home building sector from the GFC was really severe. And that raises the possibility that maybe they're not building in the Sun Belt because they couldn't reconstitute their home building sector. Number of establishments and number of employees went down 60% from 2004 to 2014. We're going to claim that's not a dominant factor. And the reason, there are a couple of reasons. The one I'll mention here is all the big Texas metros, they fully reconstituted their home building sectors. They are back above 2004 levels. And our view is, by the way, Miami's not. They're at 60% of their 2004 level. Our view is if the Texans could do it, the Floridians could too. And it was a choice. It wasn't a fundamental constraint. I'll get to this data issue in a second. The price series I want to talk about, this figure 4 in the paper, is just using 100 in 1975, real FHFA price series for 6 markets. We tell the story through a focus on 6 markets, but we have lots of data on 82 markets. What you see there is Los Angeles in the purple, and it's just rising like mad over time. It's four times more. But since the turn of the century, really right after the GFC shock, the green line is Miami. It's tripled almost. The next line is Phoenix, that brownish one. Dallas is the red. Like I said, it's not news to see the coastal markets appreciating a lot. It is news to see such big changes in these Sunbelt markets, and we're going to focus on them. All right, a little bit, if you don't know much about U.S. housing markets, this is just a picture of the stock and the average annual change in total units added over time. So we used to build a lot. We don't build as much more. There's nothing alarming to take out of that figure, right? One would think if population growth is slowing, as it is, housing's durable. You don't need to keep building as much over time. This one, though, was news to both Ed and me. That's the same average annual percentage change by decade. We're using decadal census data and the 2023 ACS 5-year thing. There used to be a wide divergence in production rates across markets. And then by the 1990s, it really narrowed. And after the GFC, it took another drop down. And that's my point. If I didn't color code these things, you couldn't tell me which market was supplying what share. Gotcha. This is broad-based. It's not just the 6. So if you're worried, did we cherry pick them? No. You see basically much greater, this is 50 markets in the US, the top 50 by population as of 2020. Virtually everybody, not everybody, but virtually everybody produced more in percentage terms in the 2 decades leading up to the turn of the century than in the 2 decades after. Not quite as many, but it's still a dominant trend, is that real house price growth is greater the first 2 decades of this century than the last 2 of the previous. And then this one kind of illustrates what we think's going on. This is the top half of the quantity growth distribution from 80 to 2000. And then we went, well, what did they do the next 2 decades? And what they did varied a lot, a lot. You have Miamis of the world, which really ratcheted back production and their prices went up. That blue line is a simple regression of the y-axis variable on the x-axis. It has a t-stat of, you know, what, Ed 2.4, something like that. So it kind of, that's what's going on, is that some of these previously high supply rate markets became low supply rate markets, and if you became a low supply rate market, your price went up more, okay? All right, I'll do that. Just very briefly on neighborhood change, you're gonna have to read the paper on this. Sort of the gold standard looking at, you know, neighborhood stuff is now the LTDB. For us, it turned out not to be fabulous. And the reason is they use 2010 track boundaries and work backwards in time. We're interested in density and changes in density. Basically, you can get really endogenous numbers here, because what's going to happen is with track boundaries defined that way, less populated places are likely to have experienced high growth in the data. There are a number of other issues. So what we do in this version is a reverse LTB, which we start with 70 track boundaries, go through time. It is, we think, much less likely to incorrectly measure growth or density, but there is a downside. The downside is we have much fewer tracks in 1970 than Logan et al. Had in 2010. It's a cost, and it's there. This is what the distribution of density across tracks looks like in Phoenix, and why we like this way more than the LTDB for our purposes. This is not a criticism of other research that used it. It makes perfect sense to us. But what happens is if you compare this to the density distribution using the LTDB, you start off with very, very low densities. The median tract in 1970 has a density units per acre of 0.11, okay? Why? Because you've got Phoenix grew like mad. They expanded the number of tracks, and those 2010 track boundaries turn out to be small geographic areas. There are so many of them, it looks like the median tract's empty. That's not actually true. And then you never catch up. So you always see lower density numbers. These are the ones we use. What do we find? Slowdown in production is in the suburbs. That's an eye chart you probably can't see, but the third row of each of those markets basically shows that the suburbs, which we just defined as tracks more than 10 miles out from the urban core, they're densifying much less as you go forward in time, okay? Not surprisingly, we see more expensive tracks. And indeed, one of the things, LA, almost all the tracks now are priced well above what we have defined in previous research as minimum profitable production costs. Miami's starting to look expensive. In the latest ACS data from 2023, 41% of their tracks have a median value greater than 20% more than we think minimum profitable production cost is. Phoenix is getting there. So when you look within market, okay, last big thing we do is we estimate and produce what we call empirical supply curves. I'm going to really quickly go over this. So in some really great recent work, Nate Baum-Snow and Lou Hahn have estimated what I think of as short-run supply elasticities, and what they found was, wow, there's a lot of inelasticity out there, and Ed and I wish we'd written that paper, but they're looking over 4 years, right? And they're using a Bardic-like shift share, okay? We're looking over decades. We don't believe over decades, we don't believe there's any magic instrument that will change the amenity level, let's say, in a tract, and and it's ultimately, if you raise the amenity level and you pass enough time and you get enough high-income people there, we believe they'll be very good at stopping production, okay? So what we do is we estimate that very simple thing you see there out of a model, and the implications are really pretty simple in the model. So what's going on there? In the model, if supply conditions become more important, and the variable, for those of you who might have read this thing, is rho, if they become more important over time, what you're going to get is a flattening of the elasticity, as it were. This is from Table 6, empirical supply curves for Dallas. What's going on here? We're estimating this relationship between price and new supply in the market. Brown line is the 1970s in Dallas. And the way everything's in log terms, so you can interpret, this is what's happening to the constant in the underlying. A positive slope means the way this is measured, if you're cheap relative to the median in the market, your tract is cheap, you have little amount of production. But if you're expensive relative to the median and therefore the slope's positive, you're producing more in the high-priced areas. And that's what we see in the 70s. It's what we see in the 80s, and then it goes away in the 90s. And that's not atypical. Not all markets look like this. I did cherry pick this one because it's the simplest of, wow, in the 1990s it changed, and then it really flattened in the first 2 decades of this year. Did we do those for 6 markets? We then do it for 82 of the top 100 metros. Why did we lose 18? Because of the cost of using the reverse LTDB. The cost is that we don't have enough tracks and we don't have enough degrees of freedom to estimate that simple model. So we're stuck with 82. What does this show? That over time, the vast majority of them also showed a weakening relationship between what the price in your neighborhood, in your tract, and how much new building you're going to get subsequently. By the 2010s, there are only 7 of the 82 markets that did not suffer did not exhibit this weakening of this relationship between price and so we're not cherry picking. The density, I'll be there. So the density coefficients are statistically significant, but they're not wildly economically significant, so we don't think it's hitting a density wall. What we do think, and this is my last slide, Hao-Wen, I'm going to shut up. What we do think, that's an eye chart, and after cataract surgery, I need my glasses. 2 things come out of this. This is what happened in tracts categorized by how dense you are, think low, medium, high, and how expensive you are. Cheap, moderate, expensive. The 2 things you want to take from that table, which is 7 in the paper, is there tends to have been a marked decrease in the share of production in low density but higher price tracts. We used to build a lot in high amenity areas that people were willing to pay a lot for. We no longer do that. However, the final column is share of units coming out of high density, moderate to high price tracts. That's going up a bit over time. And what we think, that happens in Miami in a very big way, and what we think's going on there is that in places where you're already zoned for density, you can build more and put more up there. All right, so I've already summarized it. I'll stop there. Thank you very much, and I look forward to Nate and Raven's comments.
Our first discussant is Nate Baum-Snow.
Okay, really excellent paper. Really enjoyed reading this, and there's some some kind of flashing red lights here on housing supply that I think are really important to think about. So, you know, one key observation from this paper is in high-priced places, you actually tend to see less quantity growth than in low-priced places, or at least medium-priced places, which, kind of you think about it, doesn't make a lot of sense from the perspective of incentives for developers, unless it's just these high-priced places have been regulated out of the possibility of building, right? And so this is really important. And so what's happened is this convergence across markets. So this has kind of become pretty common across all housing markets in the U.S. over time. And they show this really convincingly in this paper, and I think that's really compelling. So how do we understand this, and what are the mechanisms that we can think about for driving this? Well, we definitely see low and declining productivity in the housing sector, and it's not about, but the fact that these developers have kind of reconstituted themselves after the great financial crisis, and it's a very dispersed sector with a lot of firms. So it's not about market power. Yes, we've seen increasing land use regulation, and yes, perhaps we're seeing kind of reductions in the availability of buildable land at the same time. So what's the kind of historical narrative here that I think we can use to understand this a bit, you know, a bit better? After World War II, all of these cities, especially in the interior of the US, built a lot of highways that opened up lots of land for development. That land was able to be developed kind of in big lots, many houses and large scale built at the same time. And so spreading a fixed cost over many, many units. Ed and Joe have another paper kind of talking about this, okay? And so you could get this construction at scale. And then once these neighborhoods were built up, they passed zoning regulations that kind of locks in that density. And this is what Ellickson calls straitjacket zoning, or zoning straitjackets. And then in more recent years, you know, kind of the infrastructure expansion stopped. These big tracts of undeveloped land in good locations no longer exist. And so more of the construction has to be kind of infill development and densification. And maybe that's more costly, okay? And at the same time, you know, maybe we could build more multifamily, but that's not allowed, or those are where you could do that is in very low demand central city locations, okay? And I'll show you a little bit later that there's been some reversal on that margin, which I think is a little bit hopeful, okay? So I wanted to show you kind of what's changed in the past 10 years, and this echoes some of the evidence that we saw from Joe's graphs. Okay, so this is a cohort graph. These blue lines show you for the stock of housing that existed, for example, in 1980, how much of it still existed in each of the subsequent decades. And so the slope of the line tells you about depreciation, or the fraction of units taken out of the stock each year. And you see here up until about 2010, in the right-hand side for suburbs, that depreciation rate is about 0.7% per year. But then after 2010, basically there is no housing units taken out of the stock. And so supply shifted in composition from new construction, there is still some of that, but a lot less, to just maintaining existing units in the stock. Now, the reason I show the left-hand side here, this is the small and rural counties. These are the places where land should be most abundantly available for building. We don't tend to think there's land constraints in these types of places. And in these types of places, you don't see that pattern after 2010. You still see the same depreciation rate. And yes, demand growth was quite weak, and so you see less construction, but for that reason, okay? But it's clear there's been this sort of inflection point in the past decade, and they identify that quite clearly in their paper, okay? I also wanted to show this in sort of a different dimension. They talk a lot about density, and it's exactly right, and I want to kind of illustrate that in another way. So this is a graph that has housing unit density, that is units per square kilometer, as a function of distance from the central business district. On the left is all the metro areas, the large metro areas in the country, okay? And one is kind of the indexes the farthest distance from the CBD within the central city. So those orange lines, the bottom one is the density in 1980, the next one in 2000, the next one in 2020. You see a fair amount of densification 1980 to 2000 and almost none 2000 to 2020. So just as they were saying, just as they show in their paper, you see this kind of like density cap kicking in. For the central cities, you actually see kind of the reverse. Those are the red lines, okay? In the central cities, you see very little densification between 1980 and 2000. And then, at least for the sort of middle region there, quite a bit between 2000 and 2020, okay? So it seems like maybe there's a glimmer of hope there, that central cities are starting to figure out how to accommodate more housing construction. And this is maybe even a little bit more true in sort of the highest cost, highest demand markets that have been known in part because of one of Joe's earlier papers, superstar cities. Okay. Note that the density, the vertical axis here shows densities are twice as high on average in these superstar cities as overall. And so it's clear that we can accommodate, we have the infrastructure and the facility to accommodate much higher densities than we're accommodating now in both city and suburban areas. Okay, so I think this is these facts have sort of been recognized somewhat by policymakers. And they've tried a bunch of things, and some of them have worked better than others. So what did California do? They required municipalities to allow accessory dwelling units on all properties. That doesn't seem to have generated a lot of new housing supply. Okay. What did Massachusetts do? They required municipalities to allow, to allow by right multifamily developments near transit stations. There's been a lot of resistance to that in some municipalities. They're probably going to get essentially fined for not doing it. I think it's still in progress, but maybe there's a little bit of hope there that some densification is happening because of this. Minneapolis, it's still kind of in progress, but they had some big upzoning initiative that seems to have generated quite a few new housing units and maybe reduced rents some. Where I live in Ontario, in Canada, they have planning regimes such that developers can appeal development proposals that are denied by the city up to a provincial level, which is quite development friendly. And so you see the highest rate of new housing unit construction in North America, I think largely as a result of that, plus high demand. Okay, so you know there are policies in terms of land use regulation that seem to be working at least in specific examples. And then the other thing that we learned from history, right, is that infrastructure construction can help if there are lax zoning regimes. And so you look at cities in China, cities in the Middle East, they're building like crazy, lots of skyscrapers, lots of housing, and they're building subways at the same time. That's not happened in LA. LA has built a subway that very few people ride because it goes through very low density areas, and basically these haven't been upzoned. Okay, but that's also, you know, a possibility that can happen. And then I think the other thing is you see in DC here and in New York City very high population growth, say between 2010 and 2020. These cities got a lot, the quality of life got a lot better, right? So there is this opportunity in cities, I think, for providing a lot more housing supply with relatively low constraints on it, as long as we make the cities nice enough places to live. Okay, so with, you know, I talked about sort of large fixed costs. What can that do? That can lead us to many standardized homes built on large tracts of land It can also lead to what I think mostly is what's been happening, which is bespoke single-family homes for high-income people or multifamily. And land value capitalization is going to determine kind of which one gets built where. And I think you see, one type in the suburbs and one type in the city. So I want to finish by showing you where different types of housing units have been built over time. So nationwide, what actually you see is kind of the decline in construction. This is the number of units that were built in the prior 10 years. The decline in construction was kind of middle-sized homes before the really large 4+ bedroom homes, okay? Which is kind of goes along with the story of, oh, if there's large tracts of land, you kind of build these medium-sized homes for middle-income people. That stopped before the construction of the really large homes, and now they've all kind of cratered in the past 10 years. And those are the cities that they look at in their paper. They're a little bit bigger, but you see the similar sort of pattern, okay? Though they have a little bit more of the middle-sized housing there. This is what you get in the superstar central cities only. And it's a very different pattern. You see these 0 to 1 bedroom units, actually a higher rate of construction in the past decade. And a little bit of an increase in kind of the mid-size homes, okay? So it seems like cities are starting to figure this out on how to facilitate, kind of small unit construction. And I think that's a good thing because when we think about affordability, it's kind of hard to think about these big McMansions filtering down to be units for middle-income families. But you can imagine, condos and luxury buildings in 40 years being kind of middle-income or lower middle-income housing units, okay? And so I think that, that's another challenge, that we have all these huge homes, and are they really going to be appropriate for middle-income families in the future? Okay, so in conclusion, we have a serious challenge here. I think there's some glimmers of hope in cities. And once again, we have an opportunity for the triumph of the city. Thank you.
Our second discussant is Raven Malloy.
All right, thank you. I have to start with a standard disclaimer that nothing I say is necessarily the view of anyone else in the Federal Reserve System. I also want to have a second disclaimer today, which is that Ed was my thesis advisor when I was in graduate school. And while I was in school, I worked on a number of papers with both Ed and Joe. And so they both had a large influence on me during my formative years as an economist. And you should keep that in mind, that of course I think that everything they do is fantastic. So. Now, this paper is no exception. There's a lot of really interesting data and analysis. And I just wanted to highlight what I think are kind of the 3 key contributions that I think kind of stayed with me the most. The first is that the US housing market really has changed in important ways since the early 2000s. There are a number of formerly fast-growing metropolitan areas where growth has slowed and supply has become much more inelastic. And more generally, we could say that the set of inelastic locations is no longer limited to a set of handful of cities, as Ed and Joe found in some of their earlier work. So, big difference between now and, say, 20, 30 years ago. Related to that, the declines in the supply elasticity are largely not because we're running out of land and because cities are becoming denser. So you might think that there's kind of like a natural life cycle of a city where as they grow and become denser, it just becomes harder to build and construction costs rise and the supply elasticity declines. But the analysis in their paper is largely inconsistent with this because they show that the correlation between initial density and subsequent changes in supply is actually not that big and is actually, if anything, gotten smaller in magnitude. And then the third contribution I wanted to emphasize is a theoretical point, which is that over time, housing supply regulations adjust in response to changes in local demand. Therefore, these regulations are going to be correlated with local amenities, which makes them inappropriate instruments for house prices in many circumstances. And I wanted to emphasize that because there is a lot of literature out there that tries to use supply elasticity or housing supply constraints as instruments for house prices. And I think the model in their paper shows very nicely that this can be inappropriate. So for my discussion today, I'm going to focus on a single comment, which is that I'd like Ed and Joe to clarify what they mean by an affordability crisis in the title of their paper. So almost all of the evidence on housing costs that they show in their paper is about house prices. And of course, house prices reflect the cost to purchase a home. And I would agree that there are many reasons why we should care about home ownership. So home ownership provides wealth building because the returns to housing have been so high over the last 50 years. It provides a security of living in one's own property. You don't have to worry about the landlord deciding not to renew your lease and forcing you to move. It also provides access to neighborhoods with desirable amenities because there are a lot of neighborhoods in the US where there's just not a lot of rental stock. But despite all of these advantages, I would argue that there's a more important aspect of affordability that we should focus on, and that's the price of shelter. And I say this because shelter is a basic human necessity. We just need it for survival. In addition, shelter is a large fraction of family expenditures, so changes in the price of shelter are going to have a large impact on a family's budget and what they can have left to spend on other goods and services. And then for those of you in the room who are macroeconomists, you should care about the price of shelter because that is the housing component of inflation. House prices are actually relevant for measuring inflation in the US. So what I'd like to ask today is whether the US is experiencing a crisis of shelter affordability. Now, we typically measure the price of shelter using rents because that's the cost of occupying a home. And so here are the long-run trends in real constant quality rents and house prices. These data are from some really great research by Lyons, Schertzer, Gray, and Agarastos. Their data stopped in 2006, so I've extended this series with some other sources. What's clear is that house prices have increased much more than rents over this time period. House prices have increased by about a factor of 3, and rents have increased, but the rate of increase looks pretty small. Well, the scale makes the increase in rents hard to see, so we can zoom in a little bit. I would say, maybe 1950 was a peak. So if we look at the level of rents today, we would say that maybe they've increased by about 30% in real terms relative to the kind of relatively stable period we saw from the mid-50s to the mid-60s. So is this increase enough to say that we're experiencing a crisis in shelter affordability? Well, usually when people talk about the word affordability, they mean the price of something relative to the amount of money that someone has to spend on it. And especially in policy circles, usually when people talk about housing affordability, they're talking about rents relative to incomes. So here are some basic measures of housing affordability that are common, especially in policy circles. The first one is just the median rent-to-income ratio of all renter households. And the second one is the fraction of renters that spend more than 30% of their income on rent. And you can see they both increased pretty noticeably over time. So in the 1960s and 1970s, the typical renter household spent about 1/6 of their income on rent. That's increased to about 25% more recently. And the fraction of renters spending more than 30% of their income on rent has doubled. So people point to these kinds of statistics and they say, wow, we are definitely experiencing a crisis in shelter affordability. But the big difference between these estimates and the estimates that I showed before is that these estimates do not control for the quality of the housing stock, and that turns out to matter a lot. So just to kind of illustrate, here's some data from the American Housing Survey. You can see that the fraction of rental homes with 2 or more bathrooms, with various interior amenities like a dishwasher or central air conditioning, they've all increased substantially over time. And you can easily imagine there are a number of other kinds of amenities that we can't measure in the American Housing Survey that have probably also improved over time. Things like the energy efficiency of the windows and the quality of the interior finishes and so on. Now, I think it's interesting to note that although rental housing has become nicer, it actually hasn't become larger. About 1/3 of the rental housing stock in 2023 was single family. That's actually always been true since at least the mid-1980s. And I just wanted to mention that because there's been a lot of hoopla these days about single family rental, and it turns out single family rental has always been a big part of the rental market. The distribution of unit size hasn't really changed very much in terms of square footage. Neither has the distribution of number of bedrooms. So the real question then is how much of the increase in rent-to-income ratios can be explained by these changes in the quality of the rental stock. So I tried a simple exercise to see if I could figure that out. So the first column here just shows the median actual rent-to-income ratio that I showed before. In the second column, I've taken the median rent-to-income ratio in 1980, and I've grown out the numerator with average rent growth, and I've grown out the denominator with average family income of renters. And you can see that these kind of calculations are able to mimic that actual median rent-to-income ratio pretty well. So then in the last column, I've grown out the numerator with constant quality rents, and then I'm using the same denominator. In this case, the rent-to-income ratio is no higher in 2023 than it was in 1980. So that tells us that a lot of the increase in these kind of like typical measures of shelter affordability are really because of changes in the quality of the homes that people are living in, not due to changes in the price of shelter. Now, so far I've focused on data on rents and shelter affordability for renters because that's by far the easiest thing to measure. But of course, 2/3 of the households in the United States are owner-occupants, so we'd like to know what's happened for the price of shelter for them as well. That's, of course, much harder to do. One way to look at it is to try to impute rents to owner-occupied properties based on the rents of nearby rental units that have similar characteristics. And that's what the Bureau of Labor Statistics does with their measure of owner's equivalent rent. And you can see that since they started doing this in the early 1980s, shelter prices for owner-occupants have risen at actually a slightly slower rate on net than shelter prices for renters. Now, you might be a little bit skeptical about this approach because there are many owner-occupied homes in the United States that don't have comparable rental units nearby. So I tried a different approach, which was thinking about what are the costs of living in an owner-occupied property. So I made some pretty typical assumptions about mortgage interest, maintenance, property taxes, and homeowners insurance. The one thing that I did do is because we've heard so much evidence recently about the rise in the cost of homeowners insurance, I allowed the cost of homeowners insurance to double from 2010 to 2023. And if we look at the ownership cost of a constant quality house and compare that to median family income, you'll see that actually owner costs relative to income haven't really changed very much over the past 80 years or so. The level of cost to income in 2023 is about the same as it was in 1970, 1990, 2000. The big difference, it matters a lot that I'm holding the quality of the house constant. If we look at the ownership costs of just the median home, we see a much different story. The costs relative to income in 2023 are about twice as high as they were in 1950. So again, just like with the renter stock, the quality of the owner stock has changed a lot over time. I think that fits a lot. I think it fits in well with some of the graphs that Nate was showing about changes in the size of homes being built. So in the end, I think it's clear that the rise in shelter costs relative to income has been due to changes in housing quality, not due to the quality-adjusted price of shelter. Now, I want to be careful to say that I don't think that this means that we should conclude that there is not a crisis of shelter affordability, because it's quite possible that families are being forced to live in kind of larger, nicer homes than they would choose to do otherwise. And that brings me back to Ed and Joe's paper, because they have a lot of discussion in their paper about rising construction costs and changes in housing supply constraints. And these factors might not only cause a contraction in the number of homes being built, but also in the types of homes being built towards larger, higher quality homes. Because the quality of the housing stock is so important in affecting these kind of measures of housing affordability, I think it's really important for future research to examine the reasons underlying the lack of lower quality homes. Part of it surely is just that we've become richer over time, and so families naturally are demanding larger homes. But there could be supply factors too in terms of rising construction costs. Also, perhaps the filtering of higher quality to lower quality homes has changed over time. I think another area of research we should be thinking about is whether the magnitude of the increase in the quality-adjusted price of shelter that I showed at the beginning is consistent with the very large slowdown in the growth of the housing supply that Ed and Joe showed so clearly. That it wasn't so obvious to me that given this really massive decline in the supply of housing, we would see only an increase in the quality-adjusted price of shelter of only, say, 20 to 30%. And then finally, I think it's important that we think harder about why the quality-adjusted price of housing has increased by so much more than the quality-adjusted price of shelter over time. It could be something related to the ownership costs that I showed earlier, possibly something due to changes in people's expectations for future rent growth and future house price growth. But that's clearly important because these two measures are continuing to diverge. So that's all I had. I just wanted to thank Jan and John for inviting me to discuss this paper. It was fun to read. I learned a lot. And I'm looking forward to what everyone else has to say about this topic. Thank you.
All right, let's open it up for questions. Gerald.
So perhaps I'm trying to fit this into a general thesis about this conference, about BPEA, this BPEA, which is that it seems like the global financial crisis was the original sin on China, on treasury liquidity, and then I'm not convinced that by the idea that Texas has reconstituted its home building is that's evidence that the decline in home building as a result of the global financial crisis hasn't been a big force in the increase in supply of, or the lack of housing supply, Raven's comment aside, and the increase in prices in the last 15 years.
Let me ask a question. So Nate put up a few examples of what cities have done to try to increase supply, and pointed out that some of them have worked reasonably well and some of them have worked not so well. I wanted to ask you guys, so do we think that we know how to increase supply and it's all a political economy problem, or do we not know how to increase supply?
Let me add a different price question. In Nate's charts, it was really interesting to see what types of homes were being built, in particular the size, like the 1 to 3 bedrooms were more likely to be at least growing in the superstar cities. And the story Nate told was that this was providing more affordable middle-class housing. I was wondering if a coincident demand force is retiring baby boomers who want smaller homes than the ones that they have. And what you see in the recent price spike is that the homes whose prices went up the most and came down the least with higher mortgage rates was these smaller homes, which that might be a more resilient market for these demand reasons. It's a question.
John?
So really interesting paper and discussion. I have to admit, very, very struck by Raven's remarks all about quality, which seems like such a first order thing. But I'm also struck by, in the paper, they very much emphasized that we need to think about different areas of the country. And I'm kind of wondering where that fits into the quality side. And what I have in mind, I'm struck by the remarks about Detroit, Dayton, and so on. There isn't a lot of what's been going on is, I'll call it the housing destruction that's going on. And so is what happened is we've gotten rid of all the really low quality homes. Maybe, and is that a good thing or a bad thing in areas like that part of the country? So anyway, I think an interesting question is the spatial variation in the quality, but also what's going on. I'm going to call it on the depreciation side, but the housing destruction side seems interesting.
Doug?
Thank you. Thanks to the authors and the discussants for really interesting material. My question, I think, goes mostly to Raven's comment. 20 years ago, when I had a chance to work with Raven and others at the Federal Reserve Board, the canonical housing figure we looked at was a price-to-rent ratio. And we worried about its increase and thought, well, we'd probably be okay even if the prices fell, and that turned out to not be so true. But I wondered, Raven, looking one other, I think, related picture that you could, I think your figures imply that the price-to-rent ratio has gone up by a lot. If we drew a price-earnings ratio for equities, we'd find a big increase, I think, too, over this period. And interest rates are lower in many respects than they were before. So I wonder if part of the explanation for one of your last questions just has to do with changes in discount rates or other things that cut across different asset markets.
Fabrizio?
Yeah, no, super interesting paper and discussion. My question is also about Raven's comment and how to square up with the initial facts. I mean, we saw this large increase in prices, at least in some area, and you showed that quality adjusted is pretty flat. So I was wondering, if you redo your things for quality adjusted, do you see that some areas actually, is this still true that pricing in Los Angeles go up because the quality goes up, or maybe there is actually a true increase in prices in some areas? How heterogeneous is this thing?
Adelaide?
Hi, thanks. I wanted to pick up on this idea of location, because I think if you look at, let's just interrogate quality for a second. If you're building up an apartment in Miami or Dallas, air conditioning is not as much of a luxury as it might have been in earlier places that were being built out. So I guess one can imagine what would the rent be on a unit without air conditioning in Houston. Having lived there, I can tell you it'd be substantially lower. And then washer and dryer, I think those could well be a complement to women's labor force participation. And so there might be other trends that are shifting people into quality for reasons that aren't just like pure amenities, but are other things about the characteristics of those households.
All right, let's go to the authors, but we can maybe take some more questions after that.
You want to start, Ed? Sure. Go ahead. You got to yell into a microphone so the live streamers can.
Great. So thank you very much for the questions, and thank you for the wonderful discussions. I want to, and you know, Raven, I also think everything you do is fabulous as well. So so I want to just highlight a couple of things. First of all, the initial price things are all quality adjusted. They're FHFA repeat sales indices. So the fact that in these markets prices have gone up enormously, controlling for quality, is true. What we did not show you was the prices have gone up a lot faster than income in these markets. We did not focus on that. And I was trying to sort of put something together. We could probably do a bit better of that in the paper. And certainly I take Raven's point that, you know, price did not go up a lot higher than income everywhere, and certainly rents don't seem to have gone up a lot either. I have never been enamored of the affordability metric. I've always thought this is a market, which is housing, and I can look at the price of housing and I can look at the supply of housing. And in some sense, I would rather have called this paper the housing supply crisis rather than the housing affordability crisis, because housing affordability inevitably brings together two things, which are labor income and housing prices, which are not necessarily one and the same. Two, did the GFC do it? So one of the things that seems clear when you look in individual housing markets as opposed to the US national trend is that this stuff is a 50-year trend. This stuff is not something where you say, oh my goodness, like everything was looking amazing in Miami until 2006 and then all of a sudden there was a sea change. That's not what it looks like at all. It looks like a completely sort of continuous process that has been changing since the 1970s, where once there was a strong positive relationship between prices and quantities, and that changed, and once there was something of a negative relationship between density and building, and that also changed, both of which are compatible with the view that the heterogeneity of supply conditions are driving things, which means that you no longer have a strong link between prices and building, because those high price areas are the ones that are most constrained, and you have a more positive relationship between density and building, because the dense areas are the ones where it's easiest to build in. Third thing that I want to say about, there has been a literature for at least 20 years on like the retiring people and demand for urban space question, right? It's a great question. We can go back and look at it. The usual fact, you know, when last I looked at this 15 years ago, was it didn't seem to be that potent a force in moving anything, but we can certainly check that. It's been too long since I've looked at that. What's going on in declining cities and spatial variation in quality? We can try to do a little more. There are some attempts to use repeat sales indices at the sub-city level, but they get very sparse very quickly, and so it's sort of hard to really say anything about quality adjusting at the hyper-local level. And finally, in response to John's comments, do we think we know how to increase supply? Yeah, we do. We think actually if you made a lot of land available, guys would figure it out. So I'm just, you know, this is about to hit the market, right? This is a biography of William Levitt. And it's kind of amazing what Levitt did in the 1930s and 1940s, and that he bought up these houses that, you know, by modern standards, they were built out. There were big houses on them, right? You should think Jay Gatsby, right? There are these houses in the northern part of Long Island, and he turned them into golf houses and built thousands of houses around them. And that works, and mass production works. And there are lots of ways we have for doing this, but we need to have rules that make that possible.
I have a few comments. On the price to income, for me, so we have some data in the paper. I just didn't get to it because I ran over 2 or 3 minutes already. So what strikes me, so we're using this census tract data, and we can look at median prices in the tract, and then the denominator of P to I will be the average income in that metro area. LA, 2023, price to income multiple goes from 4.03 to 7.83. That won't surprise anyone. You know, it's getting more extreme. In 2000, Detroit and Phoenix's price to income ratios were respectively 2.25 and 2.43. Okay, they looked the same. Fast forward 23 years, Detroit 2.48, doesn't change. Phoenix 4.4, 4.37. So they're becoming more costly, at least at the median in general. That's one thing. On the GFC, I would just emphasize Ed's point. This looks longer term to us. The other thing I didn't mention that's in the paper is there's another group. So in the census data, you can count the number of home builders and the number of firms, the number of employees they have. You can also count something that they distinguish called remodelers. Remodelers have shot up like mad. What we think, we can't prove this, what we think is the people who died in the home building industry, they just renamed themselves remodelers. And they're doing small scale rehabs, developments, this, that, the other. It's partly, I think, in response to Nate's point. I happen to know that figure he showed is from a forthcoming handbook chapter that he and my colleague Jill Duranton are writing on this very topic. And basically, if we're not going to build a lot of homes and we have reasonable demand, at least in some markets, not where I grew up, but in some markets, we better save the existing stock. And I think that's exactly what's happening, and it's the remodelers who are saving the existing stock, is my gut. On John's point, policy responses, do we think we know how to increase supply? Ed's certainly right, but I think there is a deep political economy constraint. It's very local control. My neighbor controls net new housing supply in beautiful Swarthmore, Pennsylvania, where I live. It's very local control, and guess what? I and my neighbors don't care that Jan would benefit from new housing in a good school district, right? It's Swarthmore. A bunch of nerdy academics willing to tax each other a lot to provide good schools. That's a pretty valuable amenity. One would think the governor of Pennsylvania might care, right? If Jan's a citizen, the president should care. And so I think when you go through Nate's list of policies, I think most of them don't work individually, except the Ontario one, where they moved the locus of control up the governmental chain. They took it out of very local control. So my sense, John, is we can upzone, we can relax this. My sense of the regulatory environment is it's an environment. It's not one thing or two things. There are roughly 30 different ways to stop a development, with the courts being the last one. So I'm not so sure we know how to increase unless we change where the locus of control is. I'm just not positive.
I don't disagree with that, Joe. I thought this question was, do we know how to do it technologically, not do we know how to do it politically.
For sure. On Raven's point, yeah, we say 4 words, Raven. Probably we should say way more than 4 words on, and maybe we should change the title. This is.
I vote for changing the title.
Yeah, we just changed the title. Because we're about the cost of accessing ownership, which comes with things accessing rentership doesn't. But yeah, that's what we do. So what we could do, so in your work with, was Andrew Pachorik, who was?
Charlie Nathanson.
So Charlie Nathanson, sure. So in that work, what they show and what we see in our data, we have one whole paragraph on this in a 45-page paper, which is price to rent ratios in LA are skyrocketing, i.e. it's the cost of accessing ownership for sure. They are rising in the Atlantas of the world, but not by as much. And about the only thing we can do over time in the census is control for bedrooms. The real price of a given number of bedrooms in Atlanta is going up at least a bit over time. So they're in that sense, but I vote we change the title, per Ed, because you're exactly right. We are about something different.
Raven?
Well, if you change the title, then I will have nothing to say in my written remarks.
We'll credit you with changing the title.
No, I did want to say that. I did want to say that, I mean, this is probably not the right audience for this, but I would be very happy if we just expunged the term housing affordability from, policy discussions and, academic work and everything, because it's a super squishy concept. Everybody uses it to mean different things. It's not well defined. And so then you get all of this confusion because people use it to mean different things. And so, but you guys did use it in the title, so that gave me license to go for it.
It certainly did.
Elaine?
So listening to this fascinating discussion makes me think whether we need to be focusing on a whole array of structural constraints that might be behind this. So I was struck by, so Ed, first of all, just mentioned permittable land. One hears anecdotally that because of the price of land, builders only find it profitable if it's sort of A quality or some minimum quality. So has that caused us to stop building as many starter units and only build luxury homes? So only through depreciation does something become a starter. I was struck by the statistic about construction labor not recovering in most markets, with an exception of Texas markets. And maybe they've relabeled themselves as remodelers, as people decided not to move up and just to fix. Or do we have constraints related to things like occupational licensing and limits on apprentices? So we as economists, we like to think, oh, well, the wage rises and you'll have more plumbers and you'll have, by the same token, more welders. But we haven't actually seen that. And so are there constraints that are related to local occupational licensing, limits on number of apprentices that a plumber can take on, or just a taste for jobs in current young generations that are holding back our ability to build more housing?
Jen?
Just a quick question related to that. You have fascinating statistics in the paper on the scale of building. And so do you think that's the main culprit behind the stagnation of construction productivity documented elsewhere? Or where would you draw the line?
Others, sorry. Go ahead.
Yeah, Rick?
Actually, you were raising an issue that I was going to ask about, just more information on this issue of productivity, because as I understand it, like particularly from the long run trend, there's been a very substantial decline in productivity. It's like declining maybe 40%. I don't know if that's, you're going to know the number. So that's an issue of not about restrictions. There's something going on in terms of making it much more expensive to build housing, and obviously the issue is, what's causing that and what kind of policy issues, so the NIMBY thing, which is clearly very, very important, probably most of us are in nice areas and we get involved in doing NIMBY, okay? So, but there's something also going on in just the ability to actually take the piece of land and not have, maybe restricted, but just to put up a structure. So maybe you can comment on that.
Jim?
I just want to bring back to the table something that was in Raven's discussion and then that Doug Elmendorf mentioned, which is this relationship between prices and rents. And sort of really naively, from an asset pricing perspective, you'd think of prices being the net present value of future rents, and that would probably apply, you'd think, to commercial real estate, and there's got to be some margin between decisions to build commercially versus for the rental properties. And so, you wouldn't think that that would necessarily hold in the, at every moment in time. But I just find this discussion. I mean, that view underpins a lot of how one thinks about housing in a macro context too. So if that view is really wrong or empirically wrong, I'd love to understand why that is.
Let's bring it back to the authors.
Ed, you want to handle the productivity? I'm going to answer. What?
I'll handle productivity and the price to rent ratio.
Fine.
And interest rates.
Right.
You handle whatever else.
You want me to start? So yeah, so I teach a class called Housing Markets at Wharton, and I had a senior executive from Toll Brothers, big builder in, and you talk about the trades. He swears the average age of a plumber in the United States is 56 years old, right? We're not producing young plumbers anymore. So for him, it's one of the biggest staffing issues the guy has. And he goes, it's the trades, everybody. So, he thinks way too many people are in college. That's number one. Number two, on land prices, yeah, I agree. And this will get partly to you, John, about the short answer would be, well, let's just build. Not really, because in a really distorted market, the scarce factor is not land. There's land everywhere. Even in the Bay Area. Just drive across the Golden Gate Bridge to County, yeah, and Marin, and there's land all over the place, right? The scarce factor is a piece of dirt with the right to build on it. It's land with a permit stamped to it, which means the first building that gets done in these highly distorted markets, the developer had to pay a fortune for the land. They can only make money by building high-quality units and selling them off at very high prices. So build, baby, build doesn't quite work in this market if it's really distorted. So do we know how to do this? Not entirely. It's tricky. One of the things we're going to have to do, though, Ed, this is easy. I can have this done at my shop, is if we I know the answer to this. If we sum the number of employees in home builders plus remodelers, everybody is back to pre-COVID years. That's going to be the other sort of, I think, thing that we'll do. Let me see. Okay, you're doing price. Okay, go ahead.
Okay, so actually, am I on?
Yeah, you are now. Yeah.
Okay, so just again on the sort of the starter homes and density point. So remember what works for cheap housing is you build a ton of it in the same place. That's exactly what Levitt did, right? A lot of homes right on top of each other. If you're building one home surrounded by 3 acres, that doesn't work for cheap housing, right? And so the whole density thing makes it impossible to deliver the stuff. Again, we can physically do it, but we can't get to the rules. Okay, housing productivity. I'm going to advertise shall we call it a companion paper, a different paper that Joe and I wrote with Bill Kerr, Leo D'Amico, and Giacomo Ponsetto, that looks at this fact that we associate with Goolsbee and Syverson, of course, of declining productivity in the construction sector. We make a couple of points, one of which is there's actually an inverted U for America's housing productivity. Okay, so from 1900 to 1940, it's kind of flat. From 1940 to 1970, it surges. Okay, proving that like the Baumol cost disease need not necessarily determine this, right? You can have massive technological change in this, and indeed, if you read the story of Levitt, you read technological change in progress, sort of massive amounts of change, and then in 1970, it goes the wrong way. We argue that this is not divorced from the zoning process, right? In our model, and we have a model of this, and we have some evidence to support it, what happens is as the zoning gets worse, as the land use regulations get worse, the projects get smaller. Because of span of control difficulties in managing an infinitely large number of projects, the firms get smaller. And smaller firms don't invest in R&D. Okay, so as you shrunk the projects, you shrunk the firms, and you shrunk the spending on investment, and you really see this in the patents that are associated with construction. Like patents in construction and patents in manufacturing go one-to-one with each other for the first until 1940, for 100 years before that. Right? Then slowly they tend to separate a little bit by 70, and then after 1970, manufacturing patents are through the roof, and construction patents are down. Okay, this is an industry in which innovation has left, in some sense, because we regulate not just the entry into this firm, but the very process of building gets, and this sort of bespoke nature of building makes it impossible to sort of do the things that yield large returns to scale. Last point about price to rent ratios and so forth. So Joe and I and Josh Gottlieb were involved in these heavy debates going back in the aughts, and the original round of this was Mayor Himmelberg and Sinai, who claimed in 2005 that given the low interest rates that were available, the high housing prices in that age were as well, right? Then, of course, the prices dropped, and that didn't seem like such a great prediction. But we wrote a paper in the wake of the crisis that sort of argued that applying a naive Gordon growth formula to thinking about what interest rates should apply to prices is just wrong, right? It's not like rent divided by the interest rate should give you the price, okay? Because, in fact, of many things. First of all, owners don't necessarily discount by their market rent, by their market interest rate, because they're all constrained. Secondly, because, in fact, all of these mortgages come with the ability to prepay. And so that delinks the current rate with what the expected future rate link is. And also because, of course, just the mean reversion of interest rates means that whatever you paid for now means that you're not necessarily going to be expected to sell at that rate at some later period. Consequently, our estimate, both from our model and from our empirical exercises, we got a semi-elasticity of like 6, which means 100 basis points is about 0.06 log points of change in prices. So you get a 6% change for 1% interest rate change. So it's a lot smaller than you would think in terms of this. And that's what we thought then, and that's why we tend to think that whatever's going on right now isn't likely to be explained purely by interest rates. Moreover, we've had, of course, this massive increase in mortgage rates, which is not immediately translated into a massive decline in housing prices as well. So with that, I will shut up and thank you again for wonderful comments from everyone.
Thank you.
All right, let's thank all the panelists. So lunch is served right outside, and the fall conference will be on September 25th and 26th in the fall. Hope to see you all there.